inflation is the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it.
I think central banks will still be hawkish. Inflation will still be stronger than they want.
Markets in general are looking for a sign that maybe central banks are, reaching the highest level of rates that they can get.
Don't count volatility out now, even though we're kind of dropping back to 20 handle levels.
There's a global shift towards a higher returns environment, but you can't get there all in one go.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down by about 1 full percentage point. TK following the biggest two-day pop on the S&P since April 2020.
Anybody believe in it? I'm out there searching. I can't find a soul that believes in it. I love the phrase. I don't even know who to give citation to. It's it's just a decidedly Wednesday. I mean, that's all there is to it. It's decidedly defensive, and that's where we are.
The UN has complained about Federal Reserve policy, Bramo. Equity market bulls have complained about Federal Reserve policy, and now the WTO is complaining about central bank policy.
Basically saying they are risking an overshoot. They are going to cause recessions. They're talking about some of the exogenous issues. They're also talking about food insecurity, debt distress. How much is this the rest of the world's problem and not the United States' problem? We've been talking about this. The narrative of this week in markets is the Fed will blink, and that will be good for risk assets. We've heard a lot of pushback to that, and we will continue to hear pushback to that if we continue to get the data that we have, which is deteriorating.
Seemingly no one's told the Fed, because the Fed doesn't know that yet. That's not what I hear from the Fed speak. And then job openings yesterday just fueled this idea that we can engineer this soft landing without a doubt, dropping by more than 1 million. That was a real move lower.
It was the biggest move lower, the biggest drop going back to 2020 also. So, if you start to see this, perhaps this is a perfect scenario for the Fed where you start to see companies not necessarily lay people off, but reduce the openings that they have. All that said, to your point, John, Fed officials still coming out and saying, we're not going to blink. Just quit it. We have to raise rates more, and just you guys have to believe in us.
John, why does the WTO just out matter? Because they nailed it last time.
Oh,
they
the growth
were
story?
out front of everyone saying, I'm sorry, it's slower than you think. There's a number of headlines here, but 2.3%. The rule of thumb on global growth, folks, is 3%. So 2.3% is a recession.
Smells like a global
recession.
recession.
It's not NBER. It's not this. It's not that. But I'm sorry. That statistic is ugly.
Would you like to squeeze in some Twitter?
Oh, please.
No, you don't fancy
I tweeted this morning.
Okay. Is that the extent of the Twitter conversation this morning?
It's a good vehicle for talking about the tots.
At least they're trading
what
just beneath.
What are we going to do here with the Elon?
They're trading just beneath the offer in the pre-market at 51.73.
So he comes out, he says 54.20, back on, let's go. What this makes me think about is all those banks that committed to financing in April when the financing costs were incredibly cheaper relative to where they are now. Are they going to be on the hook for those losses, the mark-to-market losses, as they try to offload this debt? And what kind of disruptive effect does it have on the rest of credit markets?
This market has changed so much since April.
I know.
On the equity side, Tom, and the debt side too.
Yeah, it is. And it's going to be fun here going into the jobs report on Friday. On Elon Musk, how much is he paying up? All you need to do is go to the BQ screen in the terminal, boom. Twitter is over double the valuation and price to sales of Facebook and of Snap. I've never used Snap.
No, don't know how to use it. Snap's down about 70% from the April highs.
Yeah.
That gives you an idea of how much some of these social media companies have corrected when this deal was done at this price.
And it was still thought to be overpriced at that time. And now how much have valuations changed? And again, I keep going back to the debt financing because that has a broader, more systemic reach than just the valuation of one tech company.
It's contingent on the debt coming through. It's
Let's
contingent
see.
on that.
But they made commitments.
We'll see. That's the question. We're going to catch up with Ed Ludlow a little bit later this morning. He's going to pop into the studio. Twitter down just a little bit, down 0.5% in the pre-market. Your broader equity market shaping up as follows. On the S&P 500, biggest two-day pop on the S&P, going all the way back to April 2020. We fade that this morning. We're down 0.9%. More recently, you've seen a bid come into the bond market, 370, 369.88, yields up just a little bit this morning on the session, up 6 or 7 basis points. We saw some dollar weakness weakness, the dollar strength returns. Euro dollar 99.24, euro dollar negative 0.6%. And there is a big conversation, Lisa, about some big output cuts at OPEC Plus. Crude 86.29, call it 86.30. We're down 0.2%.
This to me matters. OPEC Plus meeting for the first time in person going back to the pandemic, potentially cutting by 2 million barrels the production of OPEC Plus nations. This comes at a time when a lot of the Western nations still want to see lower prices. This is the offset to inflation. This goes against that. We're already hearing about potential pushback from President Biden's administration, what they could potentially do to offset the reduction in some of the production. Try to wrap your head around this. And nonetheless, Brent has really fallen so much. Do we see a pop back to the high 90s like a lot of people are expecting? We get a bunch of central banks speak. Perhaps they will come out and say, OK, markets, you guys are right. We're wrong. I doubt it. Fed speakers include San Francisco Fed President Mary Daly, who yesterday was adamant about the effect of inflation on lower income households, how punitive it is. She reiterated the point that you need to have price stability before you have a steady labor economy. Atlanta Fed President Raphael Bostic, and there is an ECB non-monetary policy meeting in Cyprus. Do they talk at all about the potential ramifications of the rapid tightening? And we have seen yields on the overall Bloomberg Global Aggregate Index absolutely skyrocket versus where they were back in 2020. Sub 1%, now north of 3.5%. That is the global average. How much do you get actually central banks pushing back versus saying, let's go. This is what we need to curb inflation. And at 10 a.m., we get the U.S. ISM September Services Index. Just want to point out, we've gotten a lot of negative surprises. We talk about jolts yesterday. We talk about ISM manufacturing data that came in weaker than expected. This is what the Fed wants to see. They want to see a softening. What we have seen is several steady months of negative reads, negative surprises. And John, this is interesting. Is this a positive scenario for global markets? Are people getting comfort from this, saying the economy is moving faster than perhaps the Federal Reserve is realizing?
Elisa, great work. Thank you. Another data point to look out for a little bit later, and a ton of Fed speak as well that we're all excited about. Christian Nolting joins us now, the Global CIO at Deutsche Bank Private Bank. Christian, I've asked this question so many times this year, every time we've had a bounce. A bear market rally or something more durable? What is it?
Well, I would say, first of all, it's good that markets also can turn upwards. So that was not the case for some time. I would still say the markets have to go through the earnings season first, and I would expect that to be a volatile environment because I think the market is probably too optimistic about the earnings. From that perspective, I would say we probably see some downside from that perspective. However, then I think in Q4, as inflation is probably not moving, especially in the US, not moving much higher, I think there could be opportunities for investors to move in.
Christian Nolting, the leadership of David Folkers-Landau at Deutsche Bank is simple. When the facts change, David Folkers-Landau changes. Are the facts changing for central banks where, not the modern cliche, will they blink, but are they going to amend and adjust through October?
Now, first I have to defend David here. I have to say he was very early with coming up with a recession. I think he was the first in the market, and we had good discussions about this. And now we see not facts of a recession, but I think there's more agreement, I would call, in markets that we probably go through a recession. And in the US, it might be a mild recession to be seen. I would be at least more bullish on the US than in Europe, where we think the times and the next months could be even more, let's say, costing more growth depending on the weather we have right here.
Christian, what would you be buying? You said that at some point there will be a dip. What will be your first number of purchases? A lot of people talk about how it's going to be duration, and we've seen that, right? We've seen longer dated treasuries really lead any rally. Do you get behind that kind of view?
Yeah, so certainly we think in this quarter, in the fourth quarter of the year, I think fixed income has some value. We call it now income is back in fixed income. Because we think if growth comes down, which is our forecast, and I think that's what the market is also thinking, then the rise in yield, the massive rise you've been just showing, could stop at one point in time, and that offers opportunity.
Christian, just a final question on the job openings yesterday, the JOLTS data. It dropped by more than 1 million. Pretty stunning number that really fueled this equity market drive. Can I ask you whether you think that's because those jobs got filled or because of economic weakness, those jobs openings got taken away?
I think it's not a 0-100. So I think probably it's a mixture of both. But at least from that perspective, I thought it was a good sign that there is some reaction already of Fed policy. And it's not only monetary policy, it's also the environment is, of course, is getting a bit tougher. You have QT as well. So from that perspective, I think that's to be seen positive. And that's why we think the Fed is not going 75 steps in the consecutive meetings. Probably the next one still, but then we think, and that's what the market views as well, so we agree to that, it comes down from there.
It certainly was
but
seen
it
positively.
needs to see the unemployment rate to move up. I think that's crucial.
Well, we've got to wait for Friday for that. Christian, thank you. Christian Nodding at Deutsche Bank, Private Bank. Claims sub 200K. Job openings dropping by more than 1 million. And for a more complete picture of the labour market, Lisa, you've got to wait until Friday.
Yeah, although, again, is that going to be enough, right? We got some information. Pantheon Macro, for example, said if we get more information like the ones that we got yesterday with the JOLTS data coming in that much, that will be enough for the Fed to take a pause. On the flip side, inflation is still running hot. And you can't hire enough people, and you still hear that from a lot of companies.
The line we've repeated all week, you can't fire what you couldn't hire. Didn't that just speak to jobless claims where they are and where jobless claims were last week and where job openings are now?
Well, this goes really to the point that we were talking about earlier this week, which is what if this is not a good indicator for the Federal Reserve to really track, to understand how much the froth is coming out of the market and how quickly inflation can come down?
It was a recipe to dream about a soft landing all over again, Tom. The dream is back. And that's why you see this equity
Should we
market
talk
rip.
about a prime minister who has a dream?
I'm not sure that prime minister is living the dream right now.
She's living the dream right now. The prime minister speaks. Is it in Birmingham?
It is in Birmingham.
Just explain to our American audience, waking up in America, the symbolism you see here, John.
It's a difficult moment for this prime minister. This is not the moment that I think this prime minister dreamt about when she first got this job only a month ago. Are we going to see another U-turn here on a whole range of issues, or will they double down? Now, there was a conversation at this time yesterday morning, as to whether that budget would be brought forward ahead of the Bank of England decision, and we got some freezing cold water poured over that. So the next month, I think, is going to be fascinating. Yeah. Middle of October, Lisa, you know the dates. That's when the gilt market operation ends. November 3rd is when the Bank of England meets, and then apparently you've got to wait for a budget.
And she set the precedent. If the facts change, she says she changes, well, it seems like the pushback has only continued. So does her response also continue?
Did the WTO weigh in on that as well?
You really are still bitter about the IMF,
no, I just
right?
think the IMF, the UN, the WTO.
I know.
I mean, clearly there are some very, very difficult, complex things going on right now that is getting the attention of organisations that typically wouldn't weigh in on some of these things.
That's diplomatic. Wow.
Thank you.
That was restrained.
Oh, we've only just started. Give me a chance. Futures positive. Through yesterday, we're down this morning by 0.9 of 1% on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Union has backed a new set of sanctions on Russia. Bloomberg's learned it includes support for a price cap on oil sales to third countries. Now, the sanctions also target a range of individuals and entities, including senior Russian officials and those involved in staging the recent widely condemned referendums. OPEC and its allies may make their biggest cut in oil output since 2020. The move to stabilize prices risks cranking up tensions with the U.S. At their meeting in Vienna today, OPEC Plus energy ministers will discuss cutting production by as much as 2 million barrels a day. Now, that could lead to higher gasoline prices for U.S. drivers. The world's richest person has found a way to potentially avoid a bruising courtroom battle. Elon Musk has revived his $44 billion offer to take over Twitter. Now, that proposal likely eliminates the need for a trial over whether Musk should be forced to go forward with the purchase. Bloomberg's learned that Musk's legal team sensed that the case was not going well. President Biden has pledged an additional $625 million in weapons to Ukraine. The package includes long-range rockets, ammunition, and armored vehicles. The president spoke with UK's President Volodymyr Zelensky on Tuesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Inflation is the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it. And that's where financial conditions are tight and you can get accidents as well. So there can be no rest for financial stability until we tame the inflation side of things as well. The two are intertwined.
Wonderful to hear from Jeff Yu, BNY Mellon Senior Market Strategist on the FX market at the moment. Sterling dominated much of the concerns a couple of weeks back. Liz Truss, the British Prime Minister, addressing the Conservative Party faithful in Birmingham, England at the moment. One headline from that, stormy days facing the UK. I understand, Tom, she came out to the song by M People, Moving On Up.
Just who do you think you are? Stop acting like some kind of star. Just who do you think you are?
Take it like a man.
Take it like a man, Prime Minister, if that's what you are.
Yeah, I'm not sure who those lyrics were aimed at, Tom, but the Prime Minister's address continues.
It's a symbolism thing. It's a big deal. In America, the song, when they come out to it, it's like a huge deal.
Yeah.
All the symbolism.
You think that was a big deal, M People?
You tell me.
I've got no idea.
I don't know. Let's continue here, and we will continue with Twitter. We're going to try to give you a sharp discussion here of the distinctions for Mr. Musk, for the company, and for global Wall Street right now. Edward Ludlow's followed this from the very beginning. Let me get this straight. It's at near 8 times sales. Right. The competition's at 3 or 4 times sales. He's grossly overpaying, and he's got to sell the story to Wall Street. What will they listen for?
Well, as part of the discovery process and through the court filings, Musk's only consistency was that he wants to make big changes to the platform that could only be done if it was a private entity. And a big part of that is moving it away from a platform that's dependent on advertising. In these kind of big thinking conversations with Jack Dorsey about Twitter's role in a global democracy, they wanted to remove outside influence, and the ad market doesn't allow for it to be this kind of center of freedom of speech without it.
$13 billion cash call. Sell this to Name the Firm this morning. How, did they get a preferred coupon? How does this actually happen with a company that essentially makes no money?
I think that's the biggest risk right now, right? It's a $44 billion deal, $12.5 billion of debt split between unsecured, secured bonds, and a $6.5 billion loan, and the kind of standard $500 million revolving credit line. He had all these equity financing partners lined up as well, but the world was a very different place in April. And, I guess the question for these co-partners, who are many of them well-known associates of him, is how much do you trust Elon Musk going into a deal like this based on the behavior of recent weeks? Because frankly, I don't pretend to understand the psychology of Elon Musk. We don't know why he U-turned and did this in the last 24 hours. One source tells us it's because his legal team looked at the Chancery Judge, Kathleen St. Jude McCormick, what she'd done in the pre-trial hearings and conferences, and said, we ain't going to win. So, it's pretty precarious as deals go, but it's happening.
Contingent on debt finance is happening. Have we heard from the banks involved in any of this?
We haven't heard from the banks, but you'd imagine they're nervous. Leveraged debt is a hard sell right now. And those banks have got to go to the asset managers and say, not just that this is an attractive proposition, and the banks themselves end up with some significant loss, particularly on the unsecured portion, I'd imagine. But also, they've got to sell the vision of what Elon Musk plans to do with Twitter in the long term. And remember, this is a man that's gone on stage and said, I don't care about the economics of Twitter. I'm not doing it for financial reasons. What you're saying is critical,
particularly with the memory of deals 20, 30 years ago. Are you saying there's a risk here, pick on Morgan Stanley, that they end up with this debt on their trading desk because they can't sell it to their asset managers, their institutional managers?
Exactly. And I think that we've done the math that there's $51 billion of leveraged debt sitting around out there in a pile. Twitter's $13 billion or $12.5 billion of it. It's a big chunk of the risk in the market right now.
Just absolutely terrible. And Lisa, the Citrix deal well of the last couple of weeks. This is a bad time to be pushing this stuff.
Yeah, there's one estimate that there's more than $50 billion of leveraged debt that banks have to sell of unsecured. And the issue is that you're not seeing that much being sold into the new issue market. So any supply, let alone $50 billion of riskier securities, could potentially really cause a disruption in a market that's already tenuous.
Lisa, explain what leveraged debt is. For mere mortals like me, I'm like, huh?
Okay, basically, it's just debt to finance a company that has a very high, relative to other companies, debt to income ratio, debt to equity valuation ratio. That's the inherent leverage in a company. That's why they are riskier, because it takes more years of profits to actually pay down that debt. And what you have is right now, people are concerned about financing a company based on valuations of, say, a year ago or even 4 months ago, given how much the market's moved away from that.
And we've stripped out the $12.5 billion margin loan component, which was originally in place, right? And he went with the more the higher proportion of equity financing. But even so, that's what I'm saying. If he's going cap in hand to partners to co-fund this, they'll look at the debt, but they'll also look at the track record of recent weeks and say, I don't want to be involved anymore. I don't know.
The deal back in April, I think had a maximum interest rate of 11.75%.
Yeah, we're probably way through.
Triple C debt is trading about 15%. So compare and contrast where we are. It's the unsecured piece of this that's highly problematic for these banks.
Especially at a time when other companies are not really selling that debt, right? So that's the mark-to-market price, not necessarily with fire sales of credit investors, but just where things are implied. It's not necessarily tested in the new issue market because there have not been those triple C issuers that have come to market. This is the big issue. People see this as a potential systemic risk, not in a massive scale, but at least to disrupt the credit markets if banks are forced to sell $50 billion. Not just Twitter, but more broadly.
I like the way we've framed it this morning here at Bloomberg. Elon Musk has revived his Twitter bid.
Well, aren't we just back to square one?
Precisely. Precisely.
Sorry.
No, precisely.
I feel a real sense of deja vu, John. I'm sorry.
I think a lot of people do. I think to sit here to say it's going to close imminently, it may well do. But I think the accurate way to frame this is the deal has been revived by Elon Musk.
You know, pick your framing. Right now, it's hard to take this too seriously based on all of the things that have to happen. That's the reason why you are seeing that discount in markets. You do wonder who's made the most money from the arbitrage here. What are the banks thinking right now? Who had a sleepless night last night thinking, oh my gosh, how much are we going to lose? I mean, really, these are the tangibles of the ripple effects of this kind of announcement.
A fascinating moment.
Yeah.
He did well, that's for sure.
Sources tell us did very well.
Ed, good to catch up. Good to see you. Thank you. Getting some headlines as well from Liz Truss, the British Prime Minister, who goes on to speak at the Tory party conference in Birmingham, England. The priority is to lower the UK tax burden. Tom, economic growth hasn't been strong enough in the UK. We've heard that a few times in the last couple of weeks.
They're making up as go. I thought the Telegraph, John, had a great article today for dummies like me of the 5 parts of the Conservative Party. Which part is she speaking to today in Birmingham?
Birmingham. You're nailing that. I'm proud of you.
She's not speaking to the Sunak crew.
Certainly not.
The Johnson crew.
Maybe that's what the song was about, Tom.
I don't know. Who's she talking to? I can't figure it out. Is it him? You're the pro.
Amrita Sen's going to join us on the energy market from Energy Aspects in just a moment from New York. This is Bloomberg. Live from New York City, good morning to you. Here's the price action worldwide, kicking things off stateside with equity futures negative on the S&P, on the Nasdaq 100, following a big 2-day pop on the S&P, the biggest since April 2020. We're down 0.8% on the S&P. On the Nasdaq, we're down 0.77%. In the bond market, yields down, and then up again. 2s, 10s and 30s. 2s up 3 to 412.54. That's just the ride. I'm explaining the roller coaster, Brown.
That's really fun.
All right. 369.88 on a 10-year, up around 6 or 7 basis points. Still well off the highs of last week, 4% last week, and we come back down again. And wrapping things up in the commodity market, can we just talk about crude? We're now talking about a 2 million barrel a day cut at OPEC Plus, and some real pushback based on reports, Lisa, coming from the United States of America, unhappy about the prospect of OPEC Plus doing just that.
There's been some rumors of possibly even releasing more from the SPR, from the Strategic Petroleum Reserve, to offset the cut in production. But this is not what they want to see, especially ahead of the midterms.
And Tom, maybe even constraining exports.
Yeah, the export dynamic and frankly, in every country, I think it's political. Frankly, in Russia, it's political. There's some real nuances there, and that's what we hear from we're going to have Amrita Sen here in a moment. And
Looking forward to
that. I think she's really, out front on that as well.
We've got a man in Vienna right now, Bloomberg's Manus Cranny, my good friend. Manus, good to catch up, buddy. Walk me through what we're expecting through the next couple of hours.
Jonathan. Welcome to the Central Bank of Oil. Welcome to the bowels of OPEC. This is where the decision is going to be made. Yeah, you talk central banking on your show all the time, like the analogy. They're going to come here. They're going to talk about perhaps a monster pivot and a monster cut of up to 2 million barrels a day. Now, is that going to really change the narrative and change the dial? Maybe in real terms, it's going to be a reduction of around 900,000 barrels on the market out there. But it is regrasping the narrative, redefining the forward guidance by His Royal Highness Prince Abdulaziz bin Salman, the Saudi oil minister. And to the point that you've just made, they are ouching like heck in the White House. Bob McNally is here from Rabidin Energy in the audience in front of me. He came on the telly this morning and he said they're panicking in the White House. They flew to Saudi. They fist bumped His Royal Highness. And what do you get? 2 million barrels a day of a cut. Then Masroui, the Emirati oil minister, we doorstepped him. We will not use OPEC as a political organization. Recession. Recession is the risk. Recession is the moniker for this 2 million a day cut that they're putting on the table. By the way, in the report, in the OPEC report, we're going to expect a demand growth of around 2.7 million barrels a day, and they're cutting into that.
Manis, just quickly here, is the Russian energy minister there, and how political is that?
On his way, yes, it is political, but he is the oil minister, not the gas minister. And to a certain extent, yes, your country has sanctioned him. The Europeans have not. This is about really solidarity with Russia from the whole of OPEC. That is going down like a sack, quite literally, on the other side of the world. Maybe we're overplaying it. He's not sanctioned, and therefore he is free to come here. But you can be pretty sure of this. When the next set of sanctions kick in on Russia, you're looking at what's Russia going to do with about 2.7 million barrels a day of both oil and product. That's the start of December. That is the next shoe to drop in terms of the supply narrative here at OPEC, the Central Bank of Oil. Good morning.
Manis, good morning. You're the best. I miss you, buddy. It's good to hear from you. Manis Cranny there from Vienna on OPEC+. Manis, thank you very much. Brent crude 91.83, WTI 86.50. I think it's fair to say this could be controversial a little bit later this morning, Tom.
I think it's the memory of 1986. Joining us now, Amrita Sen of Energy Aspects as well. And, how much is the ghost of 1986 in Vienna, Amrita? And OPEC got their clock cleaned in 1986. How much are the Saudis afraid of that?
I mean, I wasn't around then, but whatever I know of that 86 cuts, I will say this much is that I don't think that's the playbook Saudis are using right now. Prince Abdulaziz has been very, very clear about a few things. And Mana said that, like, they are talking about recession, the stronger dollar. My conversations with him in particular highlight how frustrated he is and the group is about the disconnect between futures and the physical market. I do think a big part of this cut, remember he mentioned he'd written that big piece, it was an interview with Bloomberg, where he talked about OPEC could do anything really to close that gap. And he's trying to do exactly that, get the shorts out and kind of close this gap to the physical market.
Within your brilliant research note, if Saudi Arabia goes unilateral, and if they go marginally less than 2 gazillion, they go to something, to appease everybody in the cartel and all that. What does the price of oil do? What is the jump condition here from, say, 90 a barrel?
So my understanding is obviously technicals have played a very important role in the last $20 move down, and therefore they will play a very important role in the move up because it hasn't been driven by fundamentals. It's just been fears of various things. The backwardation of the crude curve remains extremely strong, which tells you that fundamentals are still very robust. So if Brent crosses 94, then we could be very quickly back above $100, but that's going to be a key resistance test. Now, from Saudi Arabia's point of view, they see this move as defensive. They believe if they don't cut big, prices could fall to $60 or $70. So regardless of what you and I think, Tom, I think it's very much about their belief of what they are doing.
What Amrita just said there, Lisa, is 1986. It's like, think of Japan and central banks. It was back in the 90s, which I believe were the 2000s, where Japan screwed up. That is precisely the collective memory of the royal family in Saudi Arabia. Don't do 1986.
What's different this time is they have also the excuse of perhaps they don't even have the capacity, the spare capacity to produce more. And Amrita, we have been hearing that as a peripheral reason for why to do this cut now. From your on-the-ground research, how much is the move driven by an expected reduction in demand due to a downturn versus a lack of spare capacity and trying to protect the reserves ahead of the next decade?
For sure, that plays a role. Look, we've been talking about the lack of OPEC plus spare capacity for years now, really. It's been over a year. And I think it's very clear. And this is why, by the way, some of these big numbers are being thrown around, because even a 2 million barrels per day cut in real life is going to be about a million, just under a million, because of underproduction. And even from the GCC's point of view, they need to preserve a fair amount of the capacity. So that is definitely playing a part. But again, to Tom's point, I don't think Saudi Arabia or any of the OPEC members want to be in a situation, say, in 2 months' time. Let's assume the macroeconomic situation does worsen. They don't want to be looking back and seeing massive surpluses of oil. They want to react ahead of it. And that's, I think, a bigger part of it. But of course, it helps to preserve their reserves as well and just kind of take it a little bit easy rather than stressing their system. Saudi Arabia is producing at 11 million barrels per day right now. That's not a number they've done sustainably in the past.
Amrita, there's a huge political overtone to this. We were talking earlier about President Biden going to Riyadh and this issue of the U.S. and other Western nations relying on OPEC Plus to produce more. What's the pushback likely, and how potentially damaging is it for the U.S. to reduce exports at a time when Europe is arguably more flat on its back when it comes to energy than the U.S.?
I mean, the irony of calling Europe allies and then banning exports is going to be something I'm sure Tom and you will discuss this at length at some point. But look, I'm in the US. I've been meeting with producers for the last week or so. US production is really underperforming and nobody's talking about that. But that's probably why, even though the White House won't admit it, that's why they're going around the rest of the world asking for more production. I have also heard from producers yesterday that there have been conversations ongoing in the White House for potentially restricting exports. It's going to backfire, but this is a global market. All it's going to do is get WTI prices down, but Brent's going to skyrocket and product prices are linked to Brent. It's not going to do anything to gasoline prices at the pump in the US.
Amrita Sen, thank you for energy aspects on the latest. The domestic politics here not lost on anybody going into the midterms. Hardly original. Of course, it makes sense. They want gas prices down going into the midterms. And gas prices just recently are starting to go the wrong way.
There's this
just
on radio. We're doing
way.
that little fancy...
Just a little bounce.
QE up. I agree. And to what she said there, can you imagine October 20th, October 25th, and Brent crude prints 101, as Amrita alluded to there?
And gasoline prices are climbing. There is a belief, among some people at least, in this oil market that by, I wouldn't say exhausting the SPR, but really bringing it down aggressively, you've made the market more fragile. You've made the market more fragile and more prone to the kind of things that we're talking about, squeezes, rallies.
Especially if you do have a lack of spare capacity, because that means you cannot increase production on demand. And what I'm most interested to hear from this particular meeting is how much they emphasize that versus the onset of some sort of recession. Because as Amrita was saying, in the physical market, there still is a significant amount of demand. And we've heard from analyst after analyst, Paul Sankey yesterday saying they expect demand to increase next year. People are still traveling. We still need commerce. And what happens if China comes back online, which you're seeing on the margins with respect to activity? So all of these issues kind of come to this muddle. And when you have a lack of supplies to unleash onto the market like the SPR, that's the point about fragility.
Gasoline prices don't have a 5-handle, Tom. On average, they have a 3-handle still, 380, but pushing 4 again. And that starts to get uncomfortable, I think, for the White House.
I agree. Is it the? I don't know. It's close to the topic. It really resonates.
I would argue it's been one of the issues of the year so far, at the epicenter.
I mean, we used to be in Boulder,
Jack, costs.
And we'd be at the sink in Boulder.
What would you be paying for?
Oh, it was 95 cents. A pitcher was the sink is a bar. We'd be paying $2.95, $3.50 for a pitcher.
John, I thought you were bringing up something connected. To the trip to the
John,
bar or something.
This is important.
You're drinking
we think
gasoline.
Nothing of a road trip to Fort Collins. You just get out west. You just get in the car and go.
Sure.
You just go.
That's been the story of the year.
Yeah. Well, that's America.
Welcome to 22.
Yeah, but you go back above $4 a gallon, you get up to $5 a gallon. I'm sorry, it matters across a huge part. So look at all of us. I mean, I've been below 59th Street in 4 months.
Don't drag me down with you. Your elite group over there.
Yeah,
I'm not a part of that at all.
Not.
Tony Crescenzi of PIMCO is going to join us shortly. Looking forward to that. Futures right now negative on the S&P 500, on the Nasdaq too. Negative after a big day of gains yesterday and the day before. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continued to bet on the outcome of the deal through months of uncertainty. Now, after Musk said he would move forward with the agreement at the original offer price, Twitter's stock rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against the move. President Biden had a muted response to North Korea's missile launch this week. He pledged to work closely with Japan and South Korea. But in his sign of permission about a bigger breakthrough, he held off, promising much more. The North Korean missile was the first to fly over Japan in 5 years. United Airlines will become one of a handful of major carriers to resume passenger flights to Hong Kong. Bloomberg's learned United will start flying there as soon as January. Hong Kong has been largely cut off to the outside world since the start of the pandemic. And in baseball, Aaron Judge of the New York Yankees is now in the record books. He hit his 62nd home run on the season Tuesday night, and that breaks a record set by Roger Maris of the Yankees in 1961. Judge has set himself up for a lucrative offseason. He'll be a free agent, and before the season, reportedly turned down a 7-year, $213 million offer from the Yankees. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Markets in general are looking for this sign that maybe central banks are, reaching the highest level of rates that they can get. Maybe we're at peak pricing. But for the Fed, at least, I would really caution that, we've been here before. We've been looking for this peak before, and it really hasn't happened.
Fantastic to catch up with Veronica Clark there, Citigroup Global Markets Economist. On a team with Andrew Hollenhorst looking for another big move from this Federal Reserve next month. Live from New York City this morning. Good morning. Here's the price action for you. After 2 days of big gains on the S&P 500, we're lower by 0.8%. We're down 28 points on the S&P 500. Yields go the other way. You guessed that, didn't you? Up 5 or 6 basis points on a 10-year to 3.69, and a dollar is stronger. Euro dollar 99.18 with negative 0.7% on that. And as we anticipate potentially a big output cut at OPEC Plus, crude Tom 87.17, positive 0.75%.
John, what matters from the WTO gas, and this goes right into the fixed income market, as it adapts and adjusts and tries to gauge, is merchandise trade. The animal spirit of trade out there next year goes from 3.4% to a stunning 1%. That is a global trade recession.
They've been very bearish before most.
They've been leading
I have to say
bearish.
That typically we joke about the IMF, the OECD coming out in forecasts and confirming what we already knew. I have to say the WTO came out pretty much in front of most of those organizations.
Oh, there it is. And it's a backdrop there, 1% again for 2023 in merchandise trade. Tony Crescenzi has these numbers tattooed to his brain. He's with PIMCO and is truly expert on the short-term space in the bond market. What does fixed income do, Tony, given a global recession and certainly from WTO, a trade recession?
Well, the bond market is starting to think about that possibility, and these yields, therefore, make it a propitious time for investors, an attractive period. The bond market's thinking the economies will weaken. They're not sure, so there's some risk premium, you could say, in prices of various assets, equities in particular. So I think it's just the uncertainty factor that's keeping markets on edge because we're not sure about how inflation will evolve in particular. But as long as there's vigilance by central banks, and there will be, it seems, Volcker-esque style in the United States, for example, it's highly likely that the inflation rate will decline. There will be disinflation. The bond market will look increasingly attractive to investors, especially if the WTO type scenario where global trade volumes shrink as much as they expect. I mean, it's shrink relative to...
Well, let's cut to the chase. Is PIMCO extending duration? Are you loading the boat on high yield this morning, Tony?
PIMCO's been underweight duration for some time. We've been reducing.
Yes, you've been leading on that.
we'd rather keep it close to neutral. Remember, when you're thinking about duration, interest rate sensitivity, you're talking about a directional strategy. If you open up the Frank Fabozzi 1,500-page book on bond investing, you see there's a lot more to do than simply bet on the direction of interest rates. And that's what PIMCO is trying to do right now, just try to stay up in quality and try to not make directional bets, to look for assets that we think would bend but not break in a time of recession and would withstand lots of different types of economic outcomes. But all that said, duration underweight, slight underweight, given the recent drop in yield, slight underweight might make sense. But remember, Tom, the Bloomberg aggregate has a duration of 6.6 years, meaning if yields move a percentage point, that the investor would lose 6.5 points.
Tony,
so a slight underweight wouldn't be much.
You said something interesting, a slight underweight. Does
so.
that imply, hi, Tony, does that imply from your perspective that we have not yet seen peak yields?
It's difficult to say. There's a wide range of scenarios, but yields today are closer to their long-term averages, and that makes it a very attractive time to be investing, for one. Secondly, the yields and the Bloomberg aggregate today, which is a compilation, by the way, for those who don't know, of treasuries, mortgages, corporates, and a bunch of other securities. It yields today, the yield is 4.6%. Now, how does that compare historically? Very good. It's closer to the long-term averages. That's one reason why bonds look quite attractive today. Secondly, where do you think the inflation rate's headed? The bond market seems to think into the low twos eventually, so that yield, high fours, looks attractive on that basis. And finally, as Tom alluded, if economies weaken, there's a chance for capital gains in fixed income now. And so one doesn't want to miss out on that. And so you have to question, are you really interested in timing the diversification benefits of bonds, which, of course, this year haven't been quite apparent, but we think will assert themselves over time.
How much are you seeing, Tony, a lot of just mom and pop investors pile into short-term treasuries for the first time in a long time? How much are you seeing those cash investments really balloon in a way that feels sticky to you, that will transform the rest of the markets, because that is money not going to equities, not going to high-yield bonds?
I recently took a trip to Asia, Korea, Singapore, and Thailand. So lots of investors there. Today I'll travel to San Francisco from New York. Been traveling a lot, seeing lots of clients, talking to them on Zoom, etc. It seems like the wagons are circling, but of course, as you could see by the global fund flows, investors are still leery. All that said, investors seem to be willing to move into the center of what we would call the concentric circle for investing. The concentric circle would have the riskless securities, treasuries, at the center, and the most risky securities at the perimeter. So investors are seeming to want to move toward the center of that concentric circle, and will slowly work their way out when they gain confidence. It'll take lots of things, lots of scenarios, of course, you can envision that cause that to occur, but they're not in place yet.
Tony, I've got some CCC unsecured debt for sale. What kind of interest would you offer on a CCC social media company?
Yeah, send it on Twitter.
As you know,
struggling for direction.
50%.
What do you reckon the
coupon? Not in areas.
What would that be, Tony?
So on the concentric circle, think of a solar system, and the concentric circle looks like that. That's like going way out to the outer perimeter of the system. So, and that's a risky gambit right now, given the uncertainties about economic growth and cash flows. Because at the end of the day, what a bond investor cares about is cash flow, getting his or her its money back. And of course, in a dour economic scenario, it becomes uncertain.
Very diplomatic, Tony. Thank you, sir.
He was very diplomatic.
Tony Crescenti there of PIMCO. Do you think that the team at Morgan Stanley and Co will be down in 1-800-PIMCO to see if Tony wants some of that stuff?
They're going to dial 1-800-TWTR Equity FA, which is the financial analysis John cash flow. 700 million plus, 120 million plus, negative 380 plus, negative 850 plus. I believe that's a trend.
It would have been a tough sale back in April. It's a much, much harder sale now, that's for sure, Lisa.
In April, it was considered overpriced. Now it's considered ridiculous, at least by market pricing. If you talk about where valuations are when it looks at the debt financing, again, how much pushback is there going to be from the banks? Basically saying, really, Elon, now you're doing this to us, heading into the year end?
I'm looking forward to reporting on this. And for that matter, I'm looking forward to the bank earnings, because some of them might actually reference this without actually naming the company. But I'm looking forward to seeing what they actually have to say.
It's going to be the fall of hung bridge loans, and that's jargon for basically debt that they have already committed to a number of different financings, usually leveraged, that they have to sell, and they have to sell probably at prices that are lower than what they would have sold earlier this year.
Pros at this. Let me ask the grizzled pros. What is secured with Twitter? What do you, if you have secured debt, what do you secured against? You get a factory?
Do you get the offices?
you
get the offices?
I don't know. I'm asking.
You get verification status.
Get verified.
Coffee mugs?
Exactly. Full verification.
Coming up, John Stolfers, Chief Investment Strategist at Oppenheimer Asset Management, live from New York with futures negative. This is Bloomberg.
Inflation's the number one priority. Until inflation is under control, monetary policy will still have to chase inflation, trying to cap it.
I think central banks will still be hawkish. Inflation will still be stronger than they want.
Markets in general are looking for a sign that maybe central banks are, reaching the highest level of rates that they can get.
Don't count volatility out now, even though we're kind of dropping back to 20 handle levels.
There's a global shift towards a higher returns environment, but you can't get there all in one go.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures negative TK down 0.7% following two big days of gains on the S&P.
Yeah, news flow today is interesting, but John, I'm going to go out an hour and 14 minutes from now to the ADP report. If ADP jolts you like jolts yesterday, what do these markets do?
ADP out a little bit later this morning, then Lisa on to payrolls on Friday.
And so how much does the market, to Tom's point, respond with a rally? Because that's what we saw yesterday with the JOLTS data coming out weaker than expected, or at least coming in with a bigger drop than expected in the job openings in the United States. Is this viewed as reason to fuel this belief that the Fed cannot go as high as they basically say they're going to go?
It's like a sports game, isn't it? A football match where you'd have these little periods where team soft landing starts to do better. The ISM, you have contractions in new orders for the third time in 4 months. Then you have job openings drop by more than 1 million. Soft landing, you dare to dream. And then you get CPI
John,
next week.
Yeah,
and you change the story
You're just bugging me here. You know this is a third rail for me. It's the gamification of what we're doing here. And what matters is the data, as we've seen the last 2 days, and looking forward to October 14th.
I personally go back to what Mohamed El-Arian said, what Mike Wilson said, which is the playbook that used to work doesn't work. And that is what perhaps we should be looking at. If this is the gamification, the game has different rules in an inflationary environment where that is the most pressing concern for policymakers and arguably for the economy itself.
Do you know what I'd like? Mike Wilson's crystal ball. Just on the desk in front of us. I went through the transcript. I went through the transcript of what he told me last week in an interview last night, just reading through the thing. And he basically said, so from here, John, what might happen is yields may well come in and then equity markets will rally, going into earnings season, kind of like the reverse of what happened in the last quarter. And then you're going to get smacked around the head with what happens with earnings. And here we are, yields came in, equity markets rallied, and we're going into earnings season. Talked about a short-term rally and then maybe going back down towards 3,400.
He's got an 8-ball on his desk, turns it upside down, it spins around, and one of them says, don't talk to Ellen Zentner, and he puts it back down.
Is that what he does? I'm not sure that's how it works out.
That's one of the choices that he's got in the 8-ball. The Morgan Stanley
I'm much more interested in the inner workings of the investment bank at JP Morgan with Bruce Kasman and Marko Kolanovic, because Bruce has a very different view on the world compared to the equity strategists over there.
Well, let's just put this into perspective. Marko Kolanovic, I mean, there's very difficult, you're not leaving me with a lot of room here. So, okay, look, Marko Kolanovic is saying, okay, well, perhaps not this year, our target is good, but next year it will be good. It will be effective next year because it doesn't look likely this year because, gosh darn the Fed, why are you doing this to us?
You mean moving out their target?
It's the Fed's fault.
That would never happen at OPCO.
But this goes to this question of the pivot discussion. Why are people buying into this belief that this is going to save the market when the Fed is saying we need inflation to come down? The inflation isn't coming down. We're going to keep going, and people keep fighting them rather than say, okay, this is what they're doing.
That's Mohammed's view of the world. Careful what you wish for. If you get the pivot, is it for all the wrong reasons? Futures right now down 0.7%. I'll whip through the price action for you on the S&P, on the Nasdaq. We are negative after 2 big days of gains. Negative on equities. Yields are a little bit higher, up 5 or 6 basis points. 368 88 on a US 10-year. In the FX market, kind of the reverse of what you saw yesterday. So yields up, dollar stronger, euro dollar negative to 99.23, down 0.6 of 1%.
Did sterling move on the trust speech? I think it did, a little weaker.
Did it? I didn't see that, Tom. What do you reckon that was on?
I don't know. Trust talked and they didn't like it.
Things move. Crude, positive 0.5 of 1%, 86.95. Lisa, going into OPEC Plus a little bit later this morning.
I am so interested to see what happens with OPEC Plus. They are meeting in Vienna. The meeting is supposed to be starting around now. How much they really go into this 2 million barrel cut in production at a time when this is highly political. You have seen Brent crude come down dramatically. Does it pop back up? What does that do heading into a winter? Not only for Europe, but also the United States. You have heard some pushback from the Biden administration on this point. Today, we get a host of central bank speak because it is a Wednesday, and why not get lots of central bank speak? Fed speakers include San Francisco Fed President Mary Daly and Atlanta Fed President Raphael Bostic. Very curious about Mary Daly's point that she made yesterday in another speech that she made, where she was talking about the punitive effect of inflation, and particularly on lower income individuals. So as we watch yields around the world surge to the highest levels in more than a decade, how much is this the necessary pain that they need to see to avoid the pain that they are feeling and that they are seeing in some of the lower income brackets, with people really seeing huge negative real wages? And at 10 a.m., we get U.S. ISF September Services Index data. And this comes as we get a series of negative economic surprises. John, this is viewed as good news for the market because people are saying, OK, then the central bank doesn't have to go as fast and as hard as they have been saying that they will. But to the point that we were just talking about, what does that mean about how quickly this economy is moving away from companies and their earnings, from consumers and their ability to spend, not just policymakers, and how much they are committed to bringing down inflation?
Lisa, thank you. Looking forward to the data later. 8:15 for the ADP report a little bit later this morning. Joining us now is John Stolfus, Chief Investment Strategist at Oppenheimer Asset Management. John, wonderful to catch up with you, sir. Let's talk about the price target. 4,800 on the S&P 500 year end. It's clearly been a difficult year for you. You can't get every single year right. I don't know if we get this massive rally in the next 3 months. You can tell me. Tell me how you and the team regroup, go back through the process, look at the framework, and have a little think about where this equity market's going.
Yeah, well, thanks for having me on the show, all. It's great to be with you today. I've got to say, this has been an incredibly tough year for the bulls. It's been a great year for the bears, although both groups have been mauled at different points. If you consider what's happened to the shorts at different within different rallies. We've had interim rallies. We had a summer rally. We've had this recent patch of rallies that we've just gone through. But when we look at it, what we'll consider is 4,800 is a little bit optimistic here, with about 26% upside from there to a 4,800 target. The problem is that right now the market really has been held hostage by technicals, by sentiment, by politics, by geopolitics, all of which factor into things. But we've got to wait to see what the earnings look like. And most importantly, what happens tomorrow in the jobs number, I think.
Yeah. John, I'm going to cut you some slack on the amount and the timeline of your strategy. Let's say you do go up 26%. Let's say it's to year end or somewhere out there in 2023 as well. Do you need catharsis in the market to get there? Do you need a VIX of 40 to go up 26% somewhere?
I think we need some support from the VIX in a more traditional sense, the way we've seen, with a really forceful spike to come down. And that perhaps, I think the most important thing to remember is that we're in this situation because of overstimulation of the economy by politicians in particular, in addition to emergency funding essentially by the Federal Reserve, in a situation that was really unprecedented in the 21st century, and we only had one global pandemic in the 20th century that I can recall. So not that I was around for the 1918 pandemic, but so when we look at it, Tom, we've got to say there's a lot of uncertainty here, but the market is telling us where it wants to go when it goes through these rally periods. And what it shows, curiously enough, is a pretty responsible barbell. Growthier value, garpier growth. The rallies are a combination of both cyclicals and defensives, with cyclicals in the lead yesterday, clearly. But it shows the battle is between the short-term investors, the intermediate to long-term investors whose goal is beyond where we are today, riding on what they see as secular opportunities, which we certainly see.
John, you said held hostage by sentiment. So the implication here is that the sentiment is wrong, that there is much more optimism right now in the economy, which gets you to that 4,800. So what are you looking for? What do you have to see to change that, to agree with the sentiment that we're headed toward recession, we haven't priced it in?
Well, I think we saw some of that yesterday. Last week, I attended the conference where you had a mix of bulls and bears speaking, and it was I was surprised to hear quite a bit of early bullishness from people who had been pretty negative on the market going into this year and throughout most of the year. What it would appear to be is, the numbers will show, and it has to be a sense of exhaustion from this selling. The question is, when you look at really good companies that are not aggressive growth companies that have dividends, and you look at them, you see they're off 30% year to date, and yet you go into the stores and you still see them being busy. Let's say companies that have all kinds of stuff for household renovation and repairs and things like that, for example, or some of the big banks that are doing business and are still not paying their depositors a heck of a lot on the money, even with the rates up. You've got to figure that something's kind of out of whack, and it may very well be that the leveraged crowd is in a state of shock because we are leaving a state of free money, going to a place where bond issuers have to pay for the privilege of borrowing money, and bond buyers are actually beginning to get paid for the risk they take when they lend money as a result of buying a bond related to inflation, related to credit risk, as well as even callability risk.
When was the last time we could say that? John, thank you. You're a good sport, sir. Can't be right all the time. It's great to catch up with you. John Stolfus there of Oppenheimer Asset Management. Forecasting is really, really difficult. It's tough, and sometimes you don't get it right. And the big bulls this year have had a tough time.
I can't say enough about it's like baseball, which I believe in hitting, is you go back to the dugout 60%, 70% of the time. That's what strategy is like. You rarely nail it like Mike Wilson.
Hey,
going in
couple
here,
of years.
That you take that gift when you get it.
Lisa is our gift, who just nailed it this year.
Yeah, I just
nailed it.
He lent me his 8-ball. Don't talk to
Zentner.
Yeah.
Bearish.
Be bearish today.
Futures down 0.8% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. OPEC and its allies may make their biggest cut in oil output since 2020. The move to stabilize prices risks cranking up tensions with the U.S. At their meeting in Vienna today, OPEC Plus energy ministers will discuss cutting production by as much as 2 million barrels a day. Now, that could lead to higher gasoline prices for U.S. drivers. Prime Minister Liz Truss warns that the UK faces what she calls stormy days. Truss spoke to the Conservative Party conference in an attempt to get her beleaguered government back on track. Now, she says she's determined to break out the high-tax, low-growth cycle and that tax cuts show that Britain is open for business. Protesters said to be from the environmental group Greenpeace briefly disrupted Truss's speech before they were escorted out. The world's richest person has found a way to potentially avoid a bruising courtroom battle. Elon Musk has revived his $44 billion offer to take over Twitter. Now, that proposal likely eliminates the need for a trial over whether Musk should be forced to go forward with the purchase. Bloomberg's learned that Musk's legal team sensed that the case was not going well. The European Union has backed a new set of sanctions on Russia. Bloomberg's learned that it includes support for a price cap on oil sales to third countries. The sanctions also target a range of individuals and entities, including senior Russian officials and those involved in staging the recently widely condemned referendums. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Every finance minister, and I add my voice to this as well, is saying whatever we do, we want to make sure that nothing will allow the energy difficulties to flow into financial instability issues. So whatever measures we take will be cognizant of the importance of financial stability here in the European Union. Every finance minister, and I add my voice to this as well, is saying whatever we do, we want to make sure that nothing will allow the energy difficulties to flow into financial instability issues. So whatever measures we take will be cognizant of the importance of financial stability here in the European Union.
That has been a dominant story over the last couple of weeks. That was the European Commissioner for Financial Stability, live from New York City this morning. Good morning. Your price action shaping up as follows on the S&P 500. Negative after some big gains over the last couple of days on the S&P. We're negative 30 points. We're down 0.8%. Yields higher, equities lower. We can't break this correlation, can we? Yields up by 5 basis points on a 10-year, 368. Futures down 0.8%. Dollar stronger, euro dollar 99.24, and crude down now by 0.6%, going into this OPEC decision at 85.95. And going into payrolls Friday, I'll give you the update on the survey at the moment. The high right now is 389, the low is 199, and the median is 263. I'll keep you up to speed on the survey as it progresses into Friday.
Than the last couple of days, I think.
I think a little bit of a drift. I wouldn't say big moves here, Tom.
Okay.
263.
Futures negative 32 this morning. Our conversation of the day on the international economy and what it means for America and, for that matter, Britain as well. Ngozi Okonjo-Iweala is Director General of the World Trade Organization. She brings absolutely bulletproof Harvard and MIT economics to the massive task of a WTO finding a place within international institutions. They found it about 6 months ago with the single best call on global slowdown of any of the institutions. All you need to know is Dr. Okonjo-Iweala and WTO was way out front. Director General, thank you for joining Bloomberg this morning. I'll get to the headline. You say merchandise trade is going to slow down off the proverbial cliff to 1% in 2023. What does that mean for the developed world? What does it mean for your Nigeria and emerging markets?
Well, thank you very much for having us. Yes, we've just released our forecast, and it's looking quite grim, a little more grim than we had thought. A real slowdown, and it's happening for several reasons. Of course, the high energy prices in Europe arising from the war in Ukraine are a big factor in this, and the squeeze on household spending, the monetary policy tightening in various developed countries that are happening, and emerging markets also is playing into this. So a whole variety of factors. What does this mean? It means that we're looking at a situation in which a global slowdown is going to squeeze households even more, squeeze businesses, and we may be edging into a recession, if not globally, at least in some.
Director General, because of time, I must interrupt and be rude, but I'm going to do it because this question is so important. Is Jay Powell, is central banker to the world, impinging on global slowdown? Are the central banks moving in the wrong direction? What is your advice off the chalkboards at the Massachusetts Institute of Technology?
It's very difficult. Jay Powell is in a tough position, whether to continue tightening, whether you'll overshoot if you do that because of looking at lagging indicators. It's very difficult to give advice to central bankers now. But there's no doubt that something has to be done about inflation. We just have to watch and see so as not to edge into an overshoot. But far be it from me to give Jay Powell advice on how to run monetary policy.
Ngozi, how much does China factor into your outlooks? How much does the potential for them to open up from a zero COVID policy or emerge from some of the downturn that they've experienced factor in or not to this forecast?
It factors in considerably into the forecast. I'd mentioned the war in Ukraine. I'd mentioned the monetary tightening, but China is another big factor. Of course, the COVID slowdown and what it means whether it's going to continue and we're going to have other lockdowns, it's a big factor. If China's economy continues to slow the way we are seeing, that will have a big impact on what happens to the world economy, as you know. And I really fear for developing countries and emerging markets.
Ngozi, just to sort of broaden out, we've been talking about how we're witnessing a sea change, where suddenly governments cannot finance themselves with deficits the way that they have before, particularly in developed markets, and central bankers cannot fuel growth by just lowering rates. How do you take that into consideration for not only this year's projection, but projection for growth over the next decade?
Well, it obviously is very, very difficult. What we are seeing in our projections is tremendous uncertainty. That I can tell you is what is really making it difficult to predict. We've never seen this amount of certainty when we do our forecasts before. But what we do see is that this uncertainty is tending to risks on the downside. So that is really impacting. And we need to look at what can we do to turn things around. How can we slow down inflationary pressures whilst looking for tools that can help us restore growth? So it's very difficult to predict. There's too much uncertainty in the air.
Director General, thank you for being with us today. And Ngozi Okonjo-Iweala there of the WTO. Lisa, I think she summed it up pretty much perfectly when Ngozi talked about how difficult it was to forecast next year. How do you forecast next month? Never mind, 2023.
Right, and that the uncertainty itself is now leading to downside risk. And you wonder, especially if you're in a corporate executive seat, how do you come up with plans for investment if you're facing the uncertainty that she's talking about with the bird's eye view of the global economy?
Or for that matter, provide guidance, Tom, next earnings season, the one we're about to go into.
Precisely. I don't think you can do guidance. It's going to be interesting to see what those conference calls are like. What I would say is the equation is Y equals C plus I plus G plus trade. And what we're hearing from the Director General is that's a complete mystery for the U.S. Does that keep us back towards recession? Tilting
Two handle on GDP, potentially. Just getting some news out of Sky News. The Chancellor in the UK is to meet with High Street bank chiefs.
Okay, can we stop?
Home loans, mortgages.
Have I ever been to High Street in London? What does High Street mean?
Main Street. You go to a bank on the High Street.
So, like, does Jamie Dimon in London have
Barclays?
But it's not like a street. It's a concept.
It's a concept.
No, I'm serious.
Are you serious? You're not aware of that? The High Street.
No, I'm not aware of that. I'm an ugly American.
Okay, all right. I'm going to let that go.
Could I just point something out?
I'm hoping that you knew that High Street wasn't like Wall Street.
It's Wall Street. It's the same kind of concept, right? It's basically big.
Is it
either
like
way,
Wall Street?
they're going to go talk to finance,
Two ugly Americans.
You guys are kidding me.
No, but it's the concept. Wall Street's become a concept.
Sure, no, but the High Street is like Main Street. Conceptually, Wall Street's actually.
So when the car drops you, north, and you walk north on that street
John's
towards
not going to be
the
here
Todd
after
Stadium,
I'm taking a break. Live from New York. This was Bloomberg Surveillance.
What's it going to be?
Coming off the back of the biggest two-day pop on the S&P 500 going back to April 2020. It's been a while. But yesterday, equities were up and yields were doing not much, and this morning it's the other way around. Equities are down and yields are a little bit higher. Futures are down by about 0.8% on the S&P. On the Nasdaq, we're down by 0.75%. Over the previous 2 days, the Nasdaq at more than 5 full percentage points. Quite a run. In the bond market, 2s, 10s and 30s. Compare it to last week, big moves lower. From 4.35 at the front end down to about 4.1%. On a 10-year, we've gone from north of 4% down to about 360-ish. Sub 370 right now, 367, yields higher by 4 basis points. Same story in the FX market. Yesterday, the last couple of days, it was about equities up and yields down and the dollar weak. A dollar a little bit stronger. The one thing I want to focus on this morning, though, is what is happening with crude. Crude is still about 30% off the highs of the year, if you're looking at WTI. But this one gets a little bit more interesting going into OPEC Plus, Tom. A real conversation about a 2 million barrel a day output cut at a time when I think this White House wants OPEC Plus to be doing something else.
Yeah, I think you're onto something here, John, in that the zeitgeist clearly is looking at this much more than global Wall Street and a 90 handle on Brent. What does that do at 96? I think the mood changes.
I'll tell you who's focused on this, Tom. Main Street in a major way. This White House, politically speaking, going into the midterms, wants gasoline prices lower. Over the last week or so, gasoline prices have started to tick just a little bit higher. Are they going to push on the SPR? Can they do something about restrictions around crude product exports? Or can they lean on OPEC Plus not to make this cut a little bit later? Something to talk about. Crude right now negative just a little bit. That's the cross-asset price action. Let's get you some single names this morning.
Twitter.
We can do that with Lisa. Morning, Lisa.
Good morning. And you know what? Tom's onto something there as well, because there is one name, and it is one name only, that is in markets today, and that is Twitter. Just to give you some sense, yesterday those shares popped 20% as Elon Musk came out and said, all right, you know how I was fighting this 54.20 valuation, this $44 billion buyout of Twitter? I'm still in. Let's go. And that left the banks scratching their heads and saying, what does that mean for us? Right now, you're seeing those shares dip just a little bit in pre-market trading, but still around $52 a share. So still a discount to what it would be if he does complete the sale because of the uncertainty. Let's talk about why there could be uncertainty. It has to do with the debt markets. Right now, banks are holding on to about $12.5 billion of financing commitments for this deal that were made in April. Let's take a look at yields on high-yield bonds from April to now. In April, they were about 6%. Now they are close to 10%, plus or minus, and they are gyrating pretty violently. But this is on average. For lower-rated credit, it's even more dramatic. How much can the banks really sell this? And how much is that going to be the circuit breaker? I mean, Tom, you can go into, different gamesmanship and whether perhaps Elon Musk is looking for banks to say no and then to go back to the court system with a better excuse. You can say whatever you want, but right now this is threatening to cause a real disruption in markets that are somewhat fragile, according to a lot of accounts, and have seen a dramatic repricing in the past 5 months.
Lisa, thank you so much. Greatly appreciated. An important conversation now with someone very informed through this tumultuous 2022. Greg Staples, with decades of experience, head of North American Fixed Income at DWS Group, joins us today in studio. ADP in 45 minutes, then claims, then jobs, and the known world is focused on some form of pivot. Your language is soft pivot. What's a soft pivot?
You know, Tom, I'd almost even call it a rotation, a slow rotation. I think that Chairman Powell probably felt he got burned a little bit in June, July, when the market, rightly or wrongly, interpreted some language as saying that he was ready to pivot, and the market rallied for 8 weeks. And I think that got in the way of the tighter financial conditions that he was looking for. And he's not there yet. He wants to be very careful that he doesn't do that again this time. I think he was probably disappointed a little bit with the rally over the last 2 days. He wants to see tighter financial conditions. You're going to have to get that to slow inflation down.
Okay, it's math-free Wednesday. The fact is the fancy mathy Bloomberg Financial Conditions Index has accommodated over the last 72 hours. To be clear, he wants to push that index to a restrictive stance?
I think he wants to see that.
How far away is he?
I think he's fairly close to it. I think he needs to do one more 75 basis point tightening, but he needs the markets to follow through. If he tightens and raises the policy rate, and you see equities go off to the races like you have for the last 2 days, I think that's going to be counterproductive to what he's trying to accomplish.
Greg, how much confidence do you have that there is some stability to the rally that we've seen in longer-term bonds, as people say that they stand to benefit regardless of what happens?
I have actually very little confidence in what we've seen over the past 2 days. I think the general trend is still higher, but not with the kind of velocity that we've seen, say, through the month of September. 4% might be a ceiling for a while. I'm not sure we're actually going to see that again in 2022. It depends, obviously, on the data that we see over the next couple of days. It's really, of course, as we've all talked about wages as the driver for inflation going forward. We've got a really data-rich week. We saw JOLTS yesterday. We're going to see ADP today. We're going to see initial and continuing claims tomorrow, and, of course, big non-farm payrolls on Friday. So many market participants, even algorithms, are primed to trade on those numbers. You're going to see knee-jerk reactions that you might regret if you trade on it immediately after a week or two.
So this is what a lot of people are saying. Don't trade these immediate knee-jerk movements. Greg, at a time when there is such potential fragility, this is what people were talking about a couple of weeks ago. How concerned are you about one event that doesn't seem that significant, say, the owner of a car company going and buying a company that is social media and then having debt sold that was priced back in April, theoretically, potentially disrupting a market that it wouldn't seem like it would do that otherwise, but because of the fragility, because of the lack of liquidity, this time could be different.
Yeah, it's clearly a question that oftentimes happens in situations like this. I think we take a little bit of comfort of the fact that so many more financial institutions are far well capitalized. There's obviously been a lot of noise about Credit Suisse this week, and we think they're actually very well capitalized, have high liquidity, That's the upside of what happened and the lessons that we learned through the great financial crisis. So I think there could be issues out there. Clearly, if you're in the leveraged finance part of major New York investment banks, you're a little nervous after the two most recent incidents, Citrix and Brightspeed, and you're looking at Twitter, you're going, oh my God, can it get any worse than this? But I don't think that threatens overall financial stability. I think we'll get through this.
Explain to our audience the path from worries of liquidity to worries of solvency in this strange word, trust. You and I have lived this. I know I'm getting the liquidity line. Things are wonderful at a given Swiss bank. But from liquidity to solvency is a dangerous path.
It can be a dangerous path, and again, that's why I think on a regulatory basis, a lot of the financial institutions have a lot more liquidity than they used to. It was forced upon them, often against their will. It's for times like this. But yes, you're absolutely right. If your counterparties won't trade with you anymore, if your depositors start removing their assets from your balance sheet, it can feed on itself fairly quickly.
You get in trouble with the General Counsel of DWS, but do you feel that Swiss regulators are lacking because there's only two major banks there?
I think it's an issue that they've got to deal with. It's not something that they can change on their own. It's the world in which they live.
There's a larger point, too, when you say that financial stability issues are not going to be the same as they had been back in 2008. How much does that take the sort of pivot off the table, that Fed officials aren't going to necessarily back off what they're doing because they're not going to break the financial system in the way that some people are suggesting they could?
Lisa, you've been talking about this for several months now, and we've been watching it very, very closely, and I think it's something you want to be concerned about. We saw it last Wednesday, right, when the Bank of England had to step in to try and stabilize the gilt market. And I think that there's a concern in the broader financial markets that something might happen within the U.S. markets, given limited liquidity, given some of the non-bank financial system growth that we've seen, that something like this will happen, and the Fed will immediately have to pivot from QT and go back to QE again. It's always a possibility. I think that they really don't want to do that. And I think they'll be far more resistant to enter into the marketplace to try and stabilize than they would have been in previous periods.
We were just speaking with the general director of WTO, and she was talking about how the uncertainty has shifted to this sort of downward feeling in the range of outcomes. How are you positioned? Because it seems like you kind of are in that camp. How have you changed your positioning over the past few weeks?
We have been in that camp for quite some time. We've been cautious very much on credit risk. We've been cautious on interest rate risk. But before this rally of the past couple of days, going into the end of the third quarter, we were actually starting to engage the market, seeing some real value, for example, in shorter duration treasuries, when we can invest for our investors at 3 or 4 year treasuries north of 4%. We think that's a pretty good place to hide out. We actually have been engaging in the mortgage-backed securities market, Fannies and Freddies. You've got 5.5% coupons on 30-year mortgages that were trading below par. I mean, that gives you a good running rate of income. You don't have to worry about credit issues. Liquidity is really good. You've got convexity risk, but we're willing to take that now because with high volatility, you're actually getting paid for that optionality that you're writing. Not going in whole hog, but stepping in piece by piece.
Triple C, unsecured debt? No?
Not yet.
Not yet.
Not yet. Not yet. Not yet.
Just asking for a friend.
I understand.
Just trying to work out if we can finance a deal. Thank you very much, sir. Greg Staples there of DWS Group. You hear that from a lot of people in fixed income, don't you? I mean, I think they know what I'm talking about, but the response I usually get is, no.
Yeah, well, I mean, and Greg was pretty honest when he said, banks wake up and they're just not happy. I mean, how could they be happy with this?
Will Twitter be triple C?
The unsecured portion of the debt was rated triple C, yeah.
Yeah.
Okay.
It's going to be difficult, Tom. I think that runs at about 15%.
15%.
Yeah.
Elon Musk.
The yield on that right now. I mean, I don't know what that one goes for.
That's even higher than what
right
Warren Buffett demands. He's like 8% preferreds.
Basically, the point is they're going to charge an arm and a leg to get this deal done. And whether this is something that's going to really be valuable for him to go through with because of X, the Everything app, we'll have to see. And I think that's really the gamble that you're seeing in stock markets right now.
Dumb question. Is this discovered today or like
no,
tomorrow?
We knew this back in April, if that's what you mean, Tom.
But it's worse now, right?
Sure, much worse over the last several months. Much worse for the banks, to be clear about that, Tom. Much worse for the banks.
Because they committed to financing at rates that were much lower. So if they sell it, they have to sell the debt at a huge discount, book losses. And this is the concern with bridge loans, not from a financial stability point, as Greg was just talking about, but from the perspective of their earnings are going to get hit yet again in an environment where deal making is already slow.
Further dumb question. If they made a commitment back in April, does that commitment stand now, or do they rip it up and do a new agreement?
I don't know the answer to that. And I'm going to wait to see what the banks have got to say.
Fair.
I imagine if Elon Musk wants to make this deal happen, then he would be a little bit annoyed. I don't want to get into the litigation of what would happen.
Yeah, that's the issue.
Does he know that I delete every single ad in my feed?
That's
I
what
block
you do.
them. I block
blocking them is how you do it.
The only one I
Blocking them
don't
is how you do
is
it.
Arsenal Soccer. I don't delete the Arsenal feed.
Do they give you promotional ads?
Yeah, I get promotions from
I didn't
Arsenal.
know that.
Yeah,
Didn't
Queen's
know that.
Park Rangers.
I just don't want to get into the litigation around the banks and Elon Musk right now. I think I'm not qualified to go there.
Either of
and it's probably the better way of
Either
putting
of us.
it. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. You heard about it. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continued to bet on the outcome of the deal through months of uncertainty. After Musk said he would move forward with the agreement at the original offer price, Twitter's stock rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against the move. Mortgage rates in the U.S. rose for the 7th week in a row to the highest in 16 years. According to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage rose nearly a quarter point to 6.75%. Rising mortgage rates led to an almost 14% decline in applications to buy or refinance a home. In Denmark, Prime Minister Mette Frederiksen has called for general elections November 1st, 7 months before her term ends. Frederiksen was pushed into calling the vote by the opposition. In July, she was reprimanded for her role in the culling of Denmark's entire 17 million mink population during the pandemic. The government was concerned the animals would transmit COVID to humans. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Such a cap on gas prices must be designed properly to ensure security of supply. Introducing a cap on gas overall is a temporary solution until we will have a new EU price index developed that ensures a better functioning of the market.
Ursula von der Leyen, then, the European Commission President. Energy, the main focus for us this morning, with OPEC Plus meeting imminently in Vienna, Austria, discussing potentially a cut to output of somewhere between 1 to 2 million barrels a day. We'll get to that in a moment. Let's whip through the price section for you on the S&P 500. Last 2 days, big two-day pop. This morning, down 0.9% on the S&P. Yields up, higher by 6 basis points, 368.88. Dollar stronger, euro dollar negative 0.75%, 99.11 on euro dollar. Call it 99.10. Crude down 0.5%, $86.12. Tom, do we have the video of Aaron Judge?
I don't think we have the video, but we have the tweet.
Smashing it out of the park.
We have a tweet. Oh, we have a presidential tweet that is important.
Congrats.
At the Judge 44.
That was emphatic, wasn't
History made. More history to make.
That's nice.
There's 10 hours ago from the President of the United States. Phillies fan. Philadelphia Phillies
Of course, that would make sense.
That would make sense.
Delaware doesn't have a baseball team.
We'll have to see. Aaron Judge doing it again with a few days to go. We speak with Yankees fan Anne-Marie Horton. Very quickly, Anne-Marie, there's some serious stuff to talk about. A big moment for the Yankees and their lore.
Yeah, huge moment. Look, I'm looking at I'm reading the New York Post this morning because every other newspaper.
Nice on radio. That looks great,
Anne-Marie.
Anne-Marie.
Want to cover this, and especially not, hometown paper, Washington Post.
Good.
You could take the girl out of New York, but you can't take the New York out of the girl. 62 home runs. Can we just say he bet on himself? The Yankees offered him an extension for nearly $215 million. He's a free agent. But how do you lose him now? How do you lose him now?
You do him for a lot of money to Steve Cohen and the New York Mets. I mean, that's what this is, where this is working out. Anne-Marie, we got too much news flow.
He's not going to Queens. Anne-Marie,
the New York Times with a great article about gas, from $5 a gallon down to $3.67 a gallon. Let's cut to the chase. Does the price of a gallon of gas in these OPEC meetings, does it matter to an election in Pennsylvania?
Well, it does matter in terms of if you see an oil price spike, that at some point will trickle down to gasoline prices. And obviously, that is one of the biggest concerns this administration has been worried about. You saw that with SPR releases. You saw the fact that at some point they were tweeting about it, Ron Klain, the president's chief of staff, almost every day when you saw the numbers start to trickle down from that $5 peak in the middle of the summer, which is why this OPEC meeting is optically very difficult for the administration, right? We are a month out from the midterm elections, inflation, gasoline prices. This is something that has been really difficult for the administration to deal with and their communication on. And now you have one of their main allies in the Gulf pushing for potentially a 2 million barrel a day cut. For some context, a 2 million barrels a day cut is 20 times more the amount of oil Biden got after his Saudi trip, but in the other direction. But there are caveats to this. A lot of these OPEC countries are not reaching their production quotas, which is why I wouldn't say the White House right now is panic-stricken. Maybe they're just slightly disappointed with the timing.
So, MH, there's a couple of options on the table. You get on the phone to the Crown Prince, you try and work something out, option one. Option two is you keep leaning heavily on the SPR. That was set to fade in the last month or so. Or option three, you consider something they've been floating for much of this year, which is do something about restricting export of crude product. Can you tell me where we are on all of those options?
Well, obviously, option one, we have not seen a phone call yet directly from the president to the Crown Prince, but to his key advisors that deal with energy and the Middle East, Brett McGurk and Amos Hochstein were recently in Saudi Arabia, so I imagine energy prices was discussed. When you look at potentially stopping exports out of the United States, while yes, this is gaining a little bit of steam in some parts of the administration, at the moment it just seems to be an idea, a tool that they could use. But many in the administration are also well aware that if you do that, that just increases prices globally and potentially could backfire.
Well, but Emery, there's a larger issue here, which is how firm is the commitment that the U.S. has made to European allies to support them through a winter that, by all accounts, is expected to be difficult?
Well, they're trying as best as they can to send over liquefied natural gas, and it's a record in terms of what U.S. producers are sending over to Europe in liquefied natural gas. I mean, the president and his advisors have made it clear that they will do, quote unquote, whatever it takes, really, to support Europe. But the issue is, obviously, is Europe is just not set up infrastructure-wise, and it's not really this winter, right? You had Ursula von der Leyen, I believe, today talking about the fact that they are 90% in terms of storage for LNG and natural gas supplies. It's next winter that's going to be the big problem.
Well, but even with LNG, right, I mean, the exports there, we heard from Secretary Granholm some issues earlier this year about even restricting those, right? I mean, that the U.S., yes, is supplying as much as they can to Europe right now and has increased dramatically those exports, but this isn't politically bulletproof. How much is the White House trying to make this politically bulletproof to secure the alliance, really, between the United States and Europe?
Well, at the moment, the U.S. can only do as much as it can, which is sending over, and these private companies sending over liquefied natural gas. Obviously, if there was export controls, you're going to hear a lot of complaints, I imagine, and phone calls from European capitals to Washington. But they're looking elsewhere as well, obviously in the Middle East, which has very much so these producers' long-term contracts with individuals in Asia. But what you're getting at, Lisa, is the fact that what we're waiting for potentially, or what we can potentially see, are cracks to the unity that the United States has really worked hard to make sure they're securing with Europe. But I would say what we have seen recently coming out of Russia, which is this rhetoric, these sham referendums, this annexation, that very difficult to find a country that believes the fact that they don't even know what territory they annex because the borders keep moving. And then, obviously, Putin saying that he potentially would use nuclear weapons, that has only brought these allies closer together and realize that even if it's going to be a tough winter, it may be worth it.
Did you bring the Yankees jacket to work? That's
I did.
all we need to know. Where is it? Are you wearing that around D.C.? There it is.
Of course.
Radio. And you know, she was going to get the Gucci New York Yankees jacket, but went with the American Ralph Lauren statement. You know, it's
well, he's from the Bronx, so
yeah,
Grand Concourse.
Okay. Well. Anne-Marie, thank you.
Lisa, comments here on the Yankees' triumph?
Well, wait till the Mets buy him.
Oh.
Sorry.
There's that love.
Well, I mean,
is that Anne-Marie's? Thanks for coming on this morning.
Anne-Marie, thank you so much for coming on. I mean, come on. You know,
is that where you think this is going?
You mentioned Stevie Cohen. You know, it depends on how big the paycheck
That is true. That is true. Can I tell you the one strange thing for a foreigner? Someone that actually does like the Yankees and Aaron Judge, and congratulations to Mr. Judge, of course.
So diplomatic.
I have to say that I found it so strange that the way this is presented and has been chased over the last couple of weeks is almost like Barry Bonds didn't even exist. Well, it's kind of bizarre.
That asterisk is toxic.
Well, it doesn't even get discussed.
It doesn't get discussed because people can't say, it's not very graceful to say, well, yeah, there was Barry Bonds, but he was
you can't say it's never
kind
been
of
done
juiced.
before when it's been done before.
But has it? Well,
physically, yeah.
Well, right, but like in technical terms, has it? Tom's just like,
yeah, kind of. It has.
How do you guys think I keep doing this? I got steroids in my tank.
I mean, it has, but it has it.
Yeah.
Oh, the tang is good.
From New York, this is Bloomberg.
Inflation is more embedded, and therefore the policy response has to be still focused on inflation.
Core inflation's around 5.5% to 6.5%. That's where wages are. That's got to come down for the Fed to eventually pivot. Until that comes down, I don't see a Fed pivot.
Really what the Fed is looking for is signs of a loosening labor market, and I don't think we get that quite yet.
This all feeds into the Fed not being happy where things are, and this softness in US yields, I don't think it will last.
The market is sniffing out the sort of top of the Fed cycle. I think bond yields have overshot and are now coming down.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on eventful, 50 minutes away, eventful Wednesday, ADP Wednesday, coming up here. The first look at the American labor economy. John, on to that report on Friday.
The Romanian central bank just blinked. Only went 25 basis points. It's a joke. Base rate 6.25. The estimate was 6%.
Really? Come on.
We did it with the RBA earlier this
know.
week. They only went 25. Anyway, no, they've lifted the base rate to 6.25. The estimate was 6. I imagine maybe they meant more than that, so we can bring that central bank decision a little bit later. Who would have thought I'd butcher the central bank decision out of Romania? Anyway.
Well, you did better than I would have. The LEU, the dollar.
They actually went. For anyone following this, they actually went 75 basis points instead of 50. So Romania didn't blink. They
didn't
big.
blink.
Is that the end of the Fed pivot now?
Yeah, that's it. We can basically say
Romania went 75.
They're the new front runner.
But can I just say the reason I say this is because I thought the RBA decision yesterday was ridiculous. Just the idea that the RBA's only gone 25 instead of 50, and that's setting the stage for every other central bank to go less than expected.
But then Jolts,
silly.
Big, 2 days up big, and there's a huge now what Wednesday to
Jolts was more important than the RBA.
Yeah.
I'll go with you on that, without a doubt. Lisa, dropping more than $1 million, telling you that perhaps this dream that we've been talking about for months, you can get job openings down without sending unemployment surging. Maybe it can happen.
And here comes the flood of cold water delivered by me, right? So Andrew Hollenhorst just putting out, this is hardly conclusive evidence that labor demand is waning rapidly enough to bring down inflation, or that the Fed is closer to achieving a soft-ish landing. Basically talking about how perhaps people have gotten over their skis. And I think there's some validity in that, right? But the issue is the fact that the market was poised so dramatically, Tom, for some sort of reversal highlights that people are still playing by the same playbook at a time when inflation has changed the game.
The data does not give us much indication here, but how important is this report in 12 minutes, John? Exactly.
ADP.
The new ADP.
ADP drives me nuts because we all sit here and say ADP is useless, and then for some reason someone trades on it. And then we get payrolls and we clear things up again. I don't think you can make a big call on the labour market just yet. Certainly we've seen jobless claims come in sub 200K. You've seen job openings drop by more than 1 million. And if you're hoping and praying, dreaming about a soft landing, that speaks to that. But you want a more complete picture. I'd be looking to see whether those job openings have come down because there's some heat coming out of this economy, or just because they got filled. People stepped up and hired a lot of people, and we'll look out for payrolls Friday for some of that, I guess.
Lisa, an update on OPEC, please.
Well, we're looking to see what they deliver and why they deliver it, right? I mean, basically, how much are they going to end up cutting 1 million barrels or 2 million barrels because they just don't have the ability to produce it?
Do we see that like this hour? Do we see this morning, John? Do we see it in your 9 o'clock
Usually,
hour?
what the OPEC Plus decision, Tom?
Yeah.
Usually you get a kind of leak from delegates of what they're going to do before they seal
Today.
the deal. Yeah, potentially in the next couple of hours. JP Morgan published a moment ago and they said the following: OPEC Plus looking to cut production with or without an agreement. I think that's interesting. They go on to say all to retest the $100 a barrel in 4Q. That's been a long-standing target for them.
Paul Sankey with some video out there on the streets of Vienna. Manus Cranny, of course, staying on tune with the story. Let's go to the data right now, John. And to me, it's sort of a clumsy day of data. I guess I'm going to say yen 144.48. We're just not where we were the excitement of the last 2 days.
When you've had a monster two-day pop on the S&P, the biggest going back to April 2020, it's unsurprising, I think, to see equities lower today by 0.9% on the S&P and yields higher. If I can tell you where equities are, you can usually guess where bonds are. So if equities are down, yields are probably up, and they are by 6 basis points, Tom, to 369.68.
86.46 on West Texas Intermediate. Brent crude, I'm going to round it up to $92 a barrel. And, of course, we'll pay attention to what we see from OPEC and what it means for your gallon of gas. Brian Nick right now, Chief Investment Strategist at Nuveen. Brian, what at the margin have you changed in your call to year-end and, far more importantly, to get 6 months out in 2023?
Yeah, I think that time horizon is really the trick. Thanks for having me on. The strategy that we've sort of employed here is to assume it's going to be sort of the same 1 step forward, 2 steps back type of market environment. And so we've opted for sort of a muddle through approach in our fourth quarter outlook, where we're sort of playing the middle. We like yield. We like less interest rate sensitivity. That's drawing us to real assets like farmland, but also in the public markets to things like high yield, which has hung in there pretty well in the third quarter and then the first 2 days of the fourth quarter now, because it's traded off so much and it has that nice cushion against a further rise in interest rates or a further deterioration in the economic outlook.
Brian, you took us into the weeds, so let's stay there. Farmland. I often hear that from certain people on programs like this. And if I'm sitting at home think, how on earth do I get exposure to what Brian's talking about? I don't have the money to buy acres and acres of farmland. Brian, how are you offering exposure to that?
Well, that's going to be mainly in the private markets, as you say. So I was trying to give an example of one, each public and private. But we're trying to sort of democratize these asset classes and try to slice and dice the minimum holding size is enough for things like especially real estate, but I think increasingly farmland as well. So investors don't have to have tens of millions of dollars in their portfolio in order to justify or to have access to a piece of farmland. A broad commodities exposure, which includes some of the agricultural output that this farmland will create. It's not quite the same type of investment, but that's also available for people who don't have that huge portfolio size. But again, it's really about finding what's going to work in a persistent high inflation environment where interest rates are whipping around and there is increasing concern about what's going to happen to the economy again in that 3 to 6 month time horizon.
John, I was thinking the same thing. How do you get scale in farmland? You just go buy North Dakota?
Money. You need money.
I mean, really. But there is this issue, Brian, where you also deal with the liquidity of farmland, the liquidity of real estate. Not so great compared to the liquidity of, say, full faith and credit of treasuries. How do you offer individual investors the access to this when there is a liquidity mismatch at a time when this is of high concern to a lot of people? What if the economy turns on a dime, and what's the consequence of that liquidity mismatch, which has often caused some serious problems?
All right, well, there's two types of liquidity. There's the actual investment vehicle that prevents you from pulling money out in a rapid way because it has to be deployed in a deliberate fashion. So that is going to be, again, an entirely different type of investment in a private market where you're not going to have daily liquidity and not daily price discovery either, which for some investors can be a good thing. If you don't see the value whipping around because nobody's assessing it, it can actually help you with composure and maintaining long-term investment strategies. Then there's the liquidity that we're seeing challenged, yes, even in the treasury market. The TIPS market has been rallying the last couple of days, I think because some liquidity has come back in, not because anything special is happening with inflation expectations. So TIPS had a pretty tough run, correlated, I think, to some of the financial concerns around the UK and the general lack of liquidity in the market. So those had sold off. So you have like this tactical liquidity risk that seeps in and out of the markets depending on the environment. And that's the one that I think we're going to have to keep a closer eye on in all of our portfolios as we move into the end of the year.
How has the marginal buyer of treasuries changed over the past 9 months, especially as you see, for example, Japanese investors have a less optimal value proposition just based on a currency hedging kind of basis?
Yeah, well, I think the official stats indicate that there's still a lot of foreign demand for U.S. treasuries. That's part of what's supporting the dollar, is that there's people around the world who are not getting as high an interest rates, especially real interest rates, as they can get in the U.S., and that's attracting a lot of people into the U.S. dollar and into U.S. treasuries. We're continuing to see demand from, I would say, lower yielding parts of the world, even for our municipal portfolios, which don't offer any tax advantage to people who are not U.S. residents, U.S. citizens, we still have demand because municipal bond yields have traded up considerably this year, too, from places like Korea, Japan, where the domestic interest rates are still quite low. So I think the demand is still there. Clearly, there's going to be, some concerns with the actual exchange rate today and how difficult it is for investors to hedge, as you point out, and to get into the dollar at these very strong levels. But I think over the course of the year, as you've seen rates moving up, the demand for dollars and demand for treasuries has been quite strong.
Brian, just quickly, what do you want from payrolls on Friday?
200,000 to 300,000 would be great. The ADP number this morning is going to be interesting because they just changed the methodology, and that has been showing a sequential decline akin to what we would expect to see in a slowing economy, whereas the payrolls number really hasn't been showing that. The JOLTS number yesterday was, sort of like, yay, there were fewer job openings, but to your point, it's not clear if those have been filled or if those are just people slashing those job openings. The only reason we're paying attention to them, I think, is because Jay Powell has said it's important, not because we think there's some great amount of information in the JOLTS numbers compared to, say, the payrolls number on Friday. So
Next time,
200,000, no change in the unemployment rate.
Next time we take the show on the road, I'm going to Nuveen for some live reaction of data. Just yay on payrolls Friday.
Yeah, right. That's exactly what we wrote.
Hey, Brian, thank you. Brian, Nick, and Nuveen. TK, yay?
Yeah, yay. I mean, we got different ways to go here, and we can do the farm thing in a minute. Here's Will Kennedy leading our coverage.
What did Will say?
On Vienna, and it's a really important point. Alexander Novak, Russia's deputy prime minister, just arrived. Quite a moment to see such a high-ranking Russia official arrive in a European Union capital, Vienna, as war rages in Ukraine. That's not a small moment.
This is what Manus mentioned earlier this morning. And we're set to have a conversation now about a 1 to 2 million barrel a day output cut at a time where this White House wants to see completely the opposite. I don't
think the White House is part of the dialogue, are they?
Right now, at this meeting,
they're not fist bumping with Mr. Novak or Russia.
Clearly not. Clearly not. But they were fist bumping with the Saudis, and I would say the Saudi vote on OPEC Plus is a bit bigger than everyone else's.
And how much is the U.S. really the elephant in the room here, sort of with respect to the alliance of OPEC Plus with Russia's presence at a time when the rest of the world is looking for even lower oil prices?
Looking forward to the outcome of this decision in Vienna, Austria. An in-person meeting that could go on longer than 13 minutes. I'm told. And an ADP report just around the corner. Mike McKee is going to sit in the chair and say yay as it crosses.
Yay.
Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. OPEC and its allies may make their biggest cut in oil output since 2020. The move to stabilize prices risks cranking up tensions with the U.S. At their meeting in Vienna today, OPEC Plus energy ministers will discuss cutting production by as much as 2 million barrels a day. Now, that could lead to higher gasoline prices for U.S. drivers. Prime Minister Liz Truss warns that the UK faces what she calls stormy days. Truss spoke to the Conservative Party conference in an attempt to get her beleaguered government back on track. She says she's determined to break out of the high-tax, low-growth cycle, and that tax cuts show that Britain is open for business. Protesters said to be from the environmental group Greenpeace. They only briefly disrupted Truss's speech before they were escorted out. The world's richest person has found a way to potentially avoid a bruising courtroom battle. Elon Musk has revived his $44 billion offer to take over Twitter. Now, that proposal likely eliminates the need for a trial over whether Musk should be forced to go forward with the purchase. Bloomberg's learned that Musk's legal team sensed that the case was not going so well. The European Union has backed off a new set of sanctions on Russia. Bloomberg's learned it includes support for a price cap on oil sales to third countries. The sanctions also target a range of individuals and entities, including senior Russian officials and those involved in staging the recently widely condemned referendums. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Right now, the pain that I hear every day, the suffering that people tell me they're going through, is on the inflation side. If we let it go, it's a corrosive disease. It's a toxin that erodes the real purchasing power of people.
Mary Daly there, the San Francisco Fed president, live from New York City this morning. Good morning. Futures lower on the S&P by 0.8%. Some data from ADP. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. And this may be good news. We don't really know because ADP has changed their formula, and we don't exactly know how it translates into Friday's numbers. But 208,000 jobs on the ADP payrolls creation during the month of September, and that's up from the 185,000, which is the revised number for August. It is sequentially lower, as Brian Nick was talking about, which is what the Fed kind of wants to see, and I guess therefore the markets want to see. But does it tell us much about what private sector job creation is going to be for the month of September as far as the government payrolls numbers? That's hard to say because this is only the second month that they've done this. Most of the jobs created in the medium-size company category. We did see 13,000 manufacturing jobs go away, which kind of is in line with what we saw from the ISM numbers, which fell below 50 this week on the manufacturing numbers. So we'll see how much validity this report has for Friday.
Mike, no big moves off the back of this in the market. Can we pick up on a data point that came out a little bit earlier this morning? Mortgage applications down by more than 14%. Your reaction to that?
I'm not surprised, but what it does look like is a real pullback very quickly now in the real estate business. Some people say, you know, when you see a number like that, you think maybe it's a seasonally affected number, but this could be real because of what's happened with mortgage rates going up so high. And it just means that the real estate sector has already rolled over from Fed rate increases. Now, does that mean it goes into the rest of the economy? And how fast does it bring down rents? Very interesting Connor Sen column today. That
he's fantastic.
A new report, and this is on the Bloomberg, a new report from an agency that tracks rentals says that rental prices are falling because far fewer people are renting now, and this could be the first sign
Where are they
of a
living
drop.
if they're not owning houses and not renting either?
Have you been home to your apartment lately? Apparently the idea is that household formation has dropped off.
Yeah.
And it skyrocketed after the pandemic. A lot of people came out and got out of their parents' houses and got married or moved in with somebody, and now that's not happening.
Okay, well, link this together for our viewers and listeners. Another headline, as John mentions at the earlier this morning data. Mortgage rates are back to 2006, 6.75%. I saw another headline, spurious, Toronto home prices down 17%. How bad is this going to be? What's your judgment after you and I living the wars of 04, 05, 08 collapse?
Well, I was one of the people who thought that we would not have a national housing collapse in 2007 because it had never happened before. I've learned my lesson.
Mark Pittman taught us that well.
I won't say that is going to happen, but it does seem that we are starting to see prices fall, which would then feed into the CPI numbers, and it takes time, but if they fall rapidly enough, maybe it will get into the numbers more quickly, and then the Fed may be able to back off sooner. But as we've seen in the United Kingdom, there can be a lot of financial stress that we don't know about out there.
Well, which goes to the financial stability issue, which we've talked a lot about. Will this cause the Fed to potentially pull back from some of the rate hiking? We heard from Eddie Ardeni saying that financial stability is going to end up more front and center than it has been, and possibly even supersede the inflation discussion. Where do mortgages fit into that?
They fit into it in a sort of very fundamental way, in the sense that the housing industry is the biggest in the United States overall and the biggest input into inflation numbers, the CPI numbers. And so when that goes up and down, it has an effect on the economy. There's a separate line item in GDP for residential investment.
We've been talking about this, and Tom Porcelio over at RBC raised it in real full. This discussion of, is the labor market the accurate gauge for the Fed to be looking at to understand how much they're taking some of the heat out of the economy to achieve their inflation goals?
It's been the traditional way. It's been a Phillips curve economy. People look at the trade-offs between inflation and employment. They don't know whether inflation dynamics have changed. So they're still looking at the labor market, but they admit there's a lot of questions about how you can tell what's happening to the economy. This is a nerd show, so I feel comfortable saying this to you
Thank
guys. I raised this with another reporter this morning who went, I don't know. Our star is the new concept here.
Okay.
A paper was presented at the New York Fed Financial Stability Conference on Friday that there is a level of interest rates after a long period of zero rates that you start to have financial stability problems, and that rate is below the neutral rate. So the Fed is going to have to fight financial stability problems before it can get to the neutral rate. I don't know if that's true, but it's getting a lot of
Has John Williams done a paper on that yet?
John Williams has not, but it was presented at his conference. Now he did the R.
There we go.
He does the R star calculation. We don't know exactly what R star is.
It's actually really interesting.
I thought it was a cut on David Bowie's last album, Lazarus.
But this is fascinating. This basically saying that they cannot allow yields to go up to where they would naturally go based on inflation and growth because of the amount of debt that has been incurred over the past few decades, that it blows up the financing system as we know it in a way that's too disruptive.
Mike and I are going to be at IMF. There's the blue book, the green book, the brown book. Guess what? Every 9 years, the green book matters. That's where we are.
It sounds like
That's
QE
simple.
forever. That Mike McKee.
Yeah.
On a serious note and a serious question, I've asked this of a few people, Mike. I'd love your insight on it. QT at the Fed, how much longer can that go on for?
They don't know. And the only way to find out is essentially to break something. They get to a level where there's some financial disruption, and there's a big discussion underway about how far they can go. The financial system is kind of messed up right now. There are regulatory issues, supplementary leverage ratio, things like that, that kind of make it hard to know exactly where they're going to go and how fast they get there.
Lisa, is it a choice between financial instability or higher inflation for longer?
Well, and this is the issue, right? Because if they have essentially end up buying bonds, having quantitative easing at a time where they're also raising rates so that they can cut off inflation, do they end up cutting their nose off to spite their face?
Bank of England last week, right? The financial stability concerns, Mike, on the one side, and then the MPC is going to meet on November 3rd, Tom, and perhaps hike interest rates big time.
It's all original. Mike, how original is this, and what are you looking for jobs on Friday?
I would say I'm looking for the sequential decline. If you're looking at something between 200 and 300,000, I know Brian Nick said this just a few minutes ago, that would represent the kind of decline, gradual and not too harmful to the economy that you're expecting. If you get a really high number, then that suggests our star comes back into play because the Fed has to raise rates higher. And then that's going to scare everybody in the markets. I'm glad I brought that concept.
Thank you.
I am too. Our star.
Did you do what Brian Nick did yesterday and just say yay when job openings came down 1 million plus?
He was right. It's just a marker along the way.
Live from New York, this is Bloomberg. Live from New York City this morning. Good morning to you all. Equities lower after 2 stellar days of gains on the S&P 500. Biggest 2-day pop on the S&P going back to spring 2020. We're down about 1% on S&P 500 futures. Mike McKee just won't go away. More economic data. Hey, Mike.
Yeah, we have the trade numbers for the month of August, which will go into third quarter GDP. As trade balance is at negative 67 billion, 67.4. That's down from 70.71. So it does suggest that trade will contribute to growth. The deficit not as big. What I haven't seen yet is the breakdown. One of the questions that's out there is, do we see a big collapse in U.S. exports because the dollar is so strong? And that's what people are going to be looking at in terms of a longer-term implications for all of this, the mix of the terms of trade.
Mike, given how closed off this economy is relative to, say, the UK, how much does that FX story actually matter to the U.S. economy?
It doesn't matter as much for the U.S. economy, but it matters for the rest of the world. We export our inflation when the dollar is so strong. It means everybody else has to tighten more. So in a sense, that could blow back to the U.S., we could see too much credit tightening, and then you end up with the greater possibility of recession. So it is a question that will come up at the IMF, Tom, about whether currencies have diverged enough from fundamentals that somebody should at least say something.
Yeah, I got a fancy chart on that we're distant from Plaza. How distant are we from a merchandise trade, summed merchandise trade recession? The WTO statistic today for next year, 1%, was stunning.
Well, those who follow it say we're very close to something like that, and it is decline in global trade that is worrying people because it's a measure sort of how the global economy is doing. And as trade collapses, people are spending less money. It's more of a problem, and it's a problem for the rest of the world even more than us. It's one of the reasons that Australia went only 25, because they're much more exposed to what's going on than the U.S. is.
As people have written in, China for Australia in the way that maybe it doesn't impact the United States. A blink, Tom, a pivot from the RBA, setting a stage for the Federal Reserve.
It is.
Or maybe not. Mike, looking forward to the interview a little bit later this morning. Mary Daly of the San Francisco Fed. Just briefly, what do you want out of that conversation?
We'd like to kind of get an idea of how far can they go? What do they think of this concept of financial instability going forward? I mean, we know they're going to raise rates. We know she'll say we'll keep them there for a while and we're committed and all that. They've said that over and over again. But what happens when something breaks?
Looking forward to it. Mike McKee, thank you, sir. In about 90 minutes' time, Tom.
Mary Daly,
Mike McKee.
Really, really important Fed president. She brings a resume and a life story that I think is hugely important for the Fed. Also at the Fed and working at the Fed with the Board of Governors for years was Michael Gapin. He's Bank of America chief U.S. economist, truly holistic on our monetary and fiscal linkages. Michael, thank you for briefing us this morning. I want to go, Michael, within the swirl of the data right now to what matters for you. We go to jobs and we go on. We stagger into November. What matters for Michael Gapin?
Honestly, only one number, and that's the payroll number. I think that there's a lot of distortion in the data, as you know, and we've talked about it many times, and it's really hard to know, which one do we take the right signal from? And so what matters to me in terms of the underlying momentum in the economy, how far the Fed may go, and the near-term course of the economy, it's almost exclusively just payrolls.
Well, let's drill into that to payrolls versus the two studies that we'll see on Friday. If I take a 3-month moving average of non-farm payrolls, the number, folks, that comes out at 8:30 that everybody reads first, what is the appropriate 3-month moving average for the Fed to say, all clear, let's change?
To move to a slower pace of hikes, you probably need that number to drop below 200,000. To get a soft landing, that number probably needs to be about 50 to maybe 70.
Wow.
So I think that it's 275, 300,000 a month. Those are still robust numbers. That tells the Fed to keep going. So pivot to a slower pace, probably below 200. But to get the unemployment rate to rise gently over a 2-year period like they're forecasting, certainly sub 100.
And that's something that is going to be hard to see. That's at least based on a lot of the projections that we've been seeing. Liz Ann Saunders actually put out some interesting charts of Charles Schwab talking about how the data is showing peripheral weakness, that you're seeing more part-time jobs appear in some of the anecdotal data. Is the headline non-farm payrolls number really the one that we should be watching for real-time changes in just how quickly this labor market is softening?
No, certainly there are other data points that are complementary to the overall picture, and I would never say we shouldn't look at those. So the JOLTS data that we received with fewer job openings, the quits rate, the ratio of openings to the unemployed. I think all those are important to provide context. And yes, they do show that on the margin, labor demand is softening and the labor market is cooling, and that's, of course, where the Fed wants to go. But I just think ultimately, the Fed's not going to conclude that the policy setting is right, the outlook for inflation is correct, if we're still adding 200,000 to 300,000 jobs a month. So at the end, yes, it comes down to where payroll growth is, where employment growth is over time, but there are certainly other data points that we should be looking at to see whether or not, are they right that we can reduce labor demand without pushing the unemployment rate up significantly. Those other data points that you mentioned, and including the jolts, can help give context around that story.
Mike, there are a lot of people pushing back and saying that inflation is actually decelerating pretty dramatically. They point to a number of different metrics, and they say that looking at the labor market data as it is not accurate. It is a misleading way to create future policy based on a lagging indicator. John's talked a lot about this. Would you agree?
Mm-hmm. In part, yes. I think you do have to be forward-looking in your policy setting. So only looking at the data under your feet at that moment in time may mean that you overcorrect in one direction or the other. And there are going to be other factors that help bring inflation down, whether it's global commodity prices or some reversal in goods prices. So wholesale used car prices being down 7 of the last 8 months, according to Manheim. We should start getting some relief from global supply chains that are going to help the Fed. So it's not just the labor market, and certainly setting policy on where the labor market is today would increase the likelihood that you make a mistake. But in some respects you have what you have, and that's the data point that over time is going to tell them where is services inflation going to end up.
Michael, and this is your wheelhouse from the days I've known you at the Fed, and that is the merchandise trade statistic of WTO today was absolutely stunning. It's a 1% 2023 growth statistic for merchandise trade. Clearly, globally, that does not get it done. What does that statistic mean for Americans?
As you discussed in your prior segment, not as much, because we're a large, relatively closed economy. Strong appreciations in the dollar like we have will slow the economy down through the trade balance. But that's a relatively narrow channel for us. It's certainly not as large as it is for other developed economies like Europe, the UK, Australia, and so forth. And what I would say is what it implies is a very weak global growth backdrop, including outside the U.S., which we all know. And that actually tends to help the U.S. because it brings lower energy prices on net, and gasoline prices fall. So the U.S. gets a windfall on the consumer side, even though a strong dollar and weak global growth is a drag through trade. So it's a more complicated picture when it comes to the U.S.
So, Mike, let's net this out. You've got a recession call on America, on the American economy. Can you just tell me on balance, are you moving that forward? Are you pushing that out? How are things developing?
We pushed it out to begin in Q1. I originally had things slowing down in the fourth quarter of the year, as data earlier this year were kind of pointing to that, but then things picked up here in the summer and the fall. I moved it out to begin in the first half of next year. At the moment, I haven't changed that. I think trends in recent weeks, the Fed's shift to being serious and lifting its policy rate, and the tightening in financial conditions that's developed, that's left me comfortable with something around Q1 or in the first half of next year. But that's when we have it starting.
Just to round it out, what about duration and depth, Mike, beyond the start point?
I spread it out over 3 quarters in part to signal a little uncertainty about start, depth, and duration. And we have the unemployment rate rising, a little above 5%, so a little more than the Fed would have it. But I think kind of in the first 3 quarters of next year is when we're likely to see our peak softness.
And the cuts start when, Mike?
December of 23.
This is what's interesting about it, though, Mike. The reason I'm not sitting here saying you've got a crystal ball. That's not why I've asked you those questions. It's interesting to me that you've got 3 quarters of recession and the cuts don't start until the very end of the year, Mike. Is that original?
Because
have you ever seen that before?
So the idea behind that is the terminal rate's about the labor market, but cuts are about inflation. And so when do they shift to a more balanced reaction function? I think, every time inflation comes in higher, it gives them a worse starting point. So it just takes a while for that to show through. But yes, it's consistent with the idea that we're going to have to accept some pain in the domestic economy to bring inflation down. So yeah, it's an odd situation, but it's a Fed right now that's saying we need the economy to slow to help us on the inflation side. So it's a different setting for them.
Fascinating. Mike, just wonderful. It's been brilliant reading your stuff since you got to B of A. It's good to have you with us this morning. Thank you. Mike Gapin there of Bank of America. Fold that into the equity call for Savita and the team. this is the issue I think a lot of people have got at play right now in the equity market. There's an economist, and look, you can debate about whether this is going to happen, depth, duration, all of the above. But the base case for Mike Apen is it starts at the start of the year, but you don't get the cuts until the end of the year.
And basically this is saying that financial stability will hold in well enough to allow the Fed to do this, and that will incur a lot of pain, at least if you're invested in risk assets.
Does that sound bullish, Tom?
I think it's original. I think we're
I'm with
making
you.
it up as we go.
I'm with you.
It's absolutely original.
Coming up at the Open, looking forward to catching up with Dan Ives of Wedbush on the Twitter deal, on the bond market, Sri Sankaran, Morgan Stanley, Rob Waldner of Invesco, and on the equity market, Sharon Ballard, Goldman Sachs, around the opening bout too. Tons to discuss in the next hour on Bloomberg TV. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Elon Musk's decision to revive his $44 billion takeover of Twitter is great news for a number of investors. They include billionaire Carl Icahn and arbitrage traders who continue to bet on the outcome of the deal through months of uncertainty. After Musk said he would move forward with the agreement at the original offer price, Twitter stocks rallied as much as 23%. The Biden administration is trying to keep OPEC and its allies from making the biggest cut in oil output since 2020. OPEC Plus is meeting today in Vienna, where energy ministers will consider cutting production by as much as 2 million barrels a day. Now, Bloomberg's learned that U.S. officials are making calls to counterparts in the Gulf, trying to push back against that move. Mortgage rates in the U.S., well, they rose for the 7th week in a row to the highest in 16 years. According to the Mortgage Bankers Association, the rate on a 30-year fixed mortgage rose nearly a quarter point to 6.75%. Rising mortgage rates led to an almost 14% decline in applications to buy or refinance a home. And private sector employers in the U.S. added a better than expected 208,000 jobs in September. And that's according to the ADP Research Institute. ADP also said that annual pay was up 7.8% in the last year. The government's monthly jobs report, well, that comes out on Friday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What we are seeing in our projections is tremendous uncertainty. That I can tell you is what is really making it difficult to predict. We've never seen this amount of certainty when we do our forecasts before. But what we do see is that this uncertainty is tending to risks on the downside.
Ngozi Okonjo-Iweala, she's Director General of the World Trade Organization, hugely qualified to stun economics, and she did so this morning with a merchandise trade statistic that was jaw-dropping 1% in 2023, which does not get it done for a global economy, and you fold that right into what we will see in Vienna right now with OPEC. And Lisa, let's mention this. Joining Bloomberg this morning, scheduled the Deputy Prime Minister of Russia,
who is going to be in Vienna at these meetings in person, a controversial aspect considering that it's in a major European city at a time, as you said earlier, there is a war between Russia after invading Ukraine. How much does that really shape the narrative when it comes to who's on whose side?
In Vienna, our man is Cranny, and again, Alexander Novak scheduled to be with us later this morning. Right now, we do better. I have no idea why he's not in the OPEC Plus meeting at the table. Christian Malik joins us now from J.P. Morgan, who's really been definitive on the how we get to a permanent $100 a barrel plus. We've seen the demand questions. Ed Morris at Citigroup gaming out nicely, Christian, $70, $80 a barrel, and suddenly we are higher. What is the single distinction that drives us to $120 a barrel?
No spare capacity, in short, Tom. I mean, we're seeing a repricing of oil to the marginal barrel, and it's away from OPEC. I know it sounds controversial to say that on a day like OPEC meeting. It's away from OPEC, and it's going back into control of the majors, who represent somewhere between 35 to 40% of the world's oil. And they're not spending, they're not investing at these levels, which then begs the question, what price will they spend? Will they grow their production and reinvest into those long-term projects? And I think we're going to need a significantly higher price, which in some ways is potentially what OPEC is trying to do today. They're trying to defend not the front end, but the back end.
The trying of OPEC. I have the memory of 1986, oil plunging 24% is my quick mathematics. How close is the cartel to a 1986?
I think in terms of how close they are, that will all depend on how demand responds to the current price. And we know that they're arguably looking for a higher price, potentially closer to where their fiscal break-evens are. Ultimately, it's not just the break-even of the countries, it's also what they want in terms of defending social reform. And we know there's a lot of issues at the moment with high energy prices. So that price level versus what the US wants suggests there's arguably a price war that's emerging between these two continents. But in the end, if demand can respond at 120 to 130, which is our house view, then I don't necessarily see demand collapsing. And then it's all about supply. It's a supply-driven crisis, which is ultimately where our super cycle thesis projects for the next 5 to 7 years.
Where are we in terms of the U.S. as a swing producer at this point, given the lack of investment in the shale patch and just generally throughout the energy sector?
Shale, it's interesting. It's like it's been dismantled. Parts have rusted. You put it back together again. It's just not as effective in terms of productivity, in terms of production volumes, and ultimately they've got used to returning cash and getting more popular with Wall Street. So you have to sort of think about what price do they need to cover all their capex, all their cash return, as well as a price that can necessarily see much bigger volumes of growth with all the money in the world, and that's much higher. That's closer to $80 to $90. So we're not seeing as much volume growth this year, closer to 700, 800,000 barrels, similar to next year, and I think that's the key.
So right now, if you're not seeing production increase and you're actually seeing production cuts at OPEC Plus, where does the marginal stopgap come in, right? We talk about the Strategic Petroleum Reserve and how much the U.S. has already drawn down on some of those reserves, the speculation that they could tap them yet again, drain them further in response to some sort of 2 million barrel production cut today. Is that bullet gone? Is it used?
Absolutely. I think it's used. And you know, I love to talk about joules, and the world is short energy, right, across all fuels. And that's what we've been talking through this year and with you. And I think the key here is if the marginal joule, if you like, is oil, then it's a bit like saying to your customers, look, I've got good news and bad news. The good news is I've got oil, still got some energy. The bad news, you're going to have to pay a lot more for it. As inventories come down and that silver bullet from the US is ultimately done, it ultimately becomes who's up for taking those barrels at the higher price.
Christian, in your definitive report of, I'm going to say 7-8 months ago, you give a fair share to ESG, to synthetics, to the other things we're going to do for energy besides oil. Give us your sense of the ESG event, given a war in Ukraine. Is it forever altered? Is it shifted?
I think what we're going to see is ultimately an upgrade of bad co to good co in this sector. And ultimately what I mean by that is this sector, we did some work last week kind of doing a bottom-up version of that Jules report for companies. And the industry, the European US majors represent roughly 20% of the world's energy in joules, 20%. Across all fuels, not just oil, gas, hydrogen, etc. And so the key here is, I think what this ESG event ultimately will evolve to is more of a hybrid of recognizing the transition is a function of this sector delivering energy on a lower carbon footprint, but ultimately delivering energy so that we don't compromise security. Yeah. And I think that will change the optics and redefine the sector's role in energy transition as opposed to being simply, in the penalty box.
I think we've lost Christian Malek, unfortunately.
I think we lost him.
Yeah, because it was fascinating to hear.
Evil winds from Vienna getting in the way of that transmission. Christian Malek with truly a definitive report, controversial report earlier this year, advancing a theme to higher oil prices as well. Lisa, where do we begin with what's been a completely nudgy day? I mean, it's just a strange day.
It's a pause in a rip-roaring rally that was the best two-day rally in the S&P 500 going back to the depth of the pandemic in 2020. And so this pause perhaps is a reset. It's a moment where people think, okay, is this actually some sort of speculation that we're going to get a softer landing, a soft-ish landing, the labor market is softening, or is this just basically a short squeeze? And that is the nudginess of this Wednesday morning.
Yeah, and we see it in currency as well. And I think, we covered it earlier, folks, and I think it's awesome off the American radar. But I'm sorry, they voted on the trust speech in Birmingham, and the answer is weaker pound sterling, called a 115 level down to a 113 handle. If that trend continues back 3-4 days, there is a signal there of sorts.
And how much support does she have at this point from her own party? I mean, and that to me is what this chart really highlights. The more she spoke, the more uncertainty there was about inflation-adjusted welfare payments, the more uncertainty there was about how this plan would get rolled out, the less certainty there is in the conviction of the pound and the rebound trade. And so how much is that going to become a theme as the months tick on?
And back to OPEC here with a nice lift, a fractional lift, I'm going to call it. West Texas rounded up 87, Brent crude 92. That's migrating to $100 a barrel.
Right now we're looking at an inability to produce, and that seems to be the theme that we heard from Christian Malik. With an inability to produce, what does that mean in terms of where prices go, and then demand destruction feeding into a downturn?
An important conversation. Our Michael McKee in conversation with the president of the San Francisco Fed. Maybe those house prices in San Francisco will come up. Mary Daly in the 10 o'clock hour. Stay with us on radio, on television. Good morning.